My name's Peter Watkins, and I'm the Global Senior Director for University Programs at CFA Institute, based in our London office. So things are really hotting up. The 6 teams competing today have already achieved significant success, winning their local competition, competing against all their neighbouring universities. They then went on to succeed in the second round of the competition based on the presentation of their excellent research analysis reports. Then, earlier this week, they triumphed once again in the live regional semi-finals, offering superb presentations and surviving a lengthy question and answer session with panels of expert judges. We really are seeing the brightest and the best finance students from right across the Americas. Congratulations to you all. The hard work you've put in is directly relevant to the content of the CFA program itself, and I hope you will all consider deepening and widening your knowledge by taking the next logical step, the CFA program and the CFA Charter, joining 200,000 other successful CFA Institute members, leading the investment profession in financial markets all around the world. You're all winners by getting this far in the competition, and we would like to recognise this by offering every participant today in this America's Regional Final a CFA Programme scholarship discount. We will share more details about this in May. I'd like to thank our volunteer panels of expert judges who have given their time and considerable commitment to support the development of all these future investment professionals from right across the region. Our judges are firm, focused, and fair, and we're very grateful to them all. Now to the details. Everyone is currently in the main session room. Throughout the event, we will move participants as appropriate to virtual breakout rooms where the presentations and question and answer periods for each team will take place. All teams, besides the first presenting teams, will be moved to their own individual rooms when the presentations start. Teams should remain connected and present in these rooms until they're moved to the presentation room. After your team has presented, you may disconnect and rejoin for the advancement announcement later. Only timekeepers, teams and judges should have sound and video enabled at any time. All other attendees should remain muted and with your video off. A 1-minute warning will be provided for the presentations, but not for the Q&A period. As a reminder, the Q&A period for the regional final round will be up to 15 minutes. For the best viewing experience, we suggest hiding non-video feeds. There are many viewing options, so we suggest taking some time to find a view that looks best to you. So, the teams competing today are Babson College representing CFA Society Boston, University of Oklahoma representing CFA Society Oklahoma, Appalachian State University representing CFA Society North Carolina, University of Alberta representing CFA Societies Calgary, Edmonton, Saskatchewan, and Winnipeg, Universidad Argentina de la Empresa representing CFA Society Argentina and CFA Society Uruguay, and University of Waterloo representing CFA Society Toronto. The judges today will be Kana Sriskanthan, CFA, Shine Lay, CFA, and Richard Maparura, CFA. Adrienne will be our timekeeper. At this time, we will start moving judges, guests, and then the first team into the presentation room.
So welcome, Appalachian State University. Please launch your presentation and make sure everything is working properly.
What happens when a company takes a hard look at itself and completely resets? For Honeywell, it's been transformative. Good afternoon. I'm Kira Andrews, joined by Brendan Wortman, Carson Bean, Jack Parkett, and Davis Farr. We are initiating coverage with a buy rating and a 1-year target price of $219, representing a 14% upside from April 9th, 2025. With continuous portfolio optimization, reinvestment into future growth, and a commitment to returning shareholder value, Honeywell presents a compelling buying opportunity.
On June 1st, 2023, Vimal Kapoor became Honeywell's CEO, bringing a clear vision for the company's future. Under his leadership, Honeywell has prioritized 3 key megatrends: the future of aviation, automation, and energy transition. As a result, the company has reorganized into 4 business units. The first of these business units are Aerospace Technologies, their largest and fastest growing business unit, making up over 40% of Honeywell's revenue in 2024. It excels in aircraft maintenance and advanced aviation technology.
The aerospace industry is characterized by technological innovation, significant capital investment, and a complex supply chain. With estimates of world plane fleets expected to grow more than double, and the aerospace industry slowly gaining defense contract share.
Honeywell's industrial automation unit makes up 30% of revenue and focuses on addressing labor shortages through warehouse automation and productivity tools. Its building automation unit makes up 16% of revenue and focuses on efficiency, offering integrated management solutions for buildings.
The automation industry is characterized by technological advancements that drive significant R&D investment, intensifying competition and creating higher barriers to entry. With Internet of Things, AI, machine learning, and advanced robotics transforming the landscape. With IoT devices expected to reach 40 billion by 2030 and AI projected to significantly boost productivity.
Honeywell's Energy and Sustainability Solutions unit makes up 17% of revenue and focuses on cleaner energy. The company produces specialty chemicals while refining crude oil and offering carbon capture solutions, benefiting from being the largest installed base in the industry.
The energy solutions industry is rapidly evolving to meet global demand with innovative sustainable solutions like renewable energy efficiency improvements, carbon capture technology, and advanced storage systems. As more companies commit to carbon neutrality, we expect for these companies to capitalize off these commitments. In addition to identifying Honeywell's closest peers in each industry based on operations, products, and services, we also identified their conglomerate-like peers based on size, structure, and product offerings.
Honeywell is firing on all cylinders. With a strong financial position and a strategy built for long-term growth, its return on equity has averaged 31% over the last 5 years. While deleveraging may slightly reduce ROE, Honeywell's returns remain solid, consistently outperforming all competitor peer groups. The real game changer? A shift toward higher margin services driving profitability. Since 2018, service revenue has grown from 21% to 31% of total sales, and we project by 2028 it will grow to 37%. Higher margin services and efficiency gains position Honeywell ahead of competitors, and our forecasts indicate that net profit margins will grow from 15% in 2024 to 17% by 2028. Honeywell is optimizing operations, cutting its factory footprint in half while boosting efficiency. Although inventory turnover trails competitors, fixed asset turnover surpasses many, demonstrating Honeywell's ability to extract more value from its resources. On the capital side, Honeywell's debt is up 56% since 2023 to $26 billion. While this brings its debt ratio to 64%, its strong credit rating and high interest coverage indicate it can effectively manage this leverage.
Through our ESG risk assessment, we concluded the company maintains an overall average risk score, but ranks top 10% in its industry for risk mitigation. Honeywell is minimizing its environmental impacts through greenhouse gas intensity reduction, as well as advancing its CO2 reducing Solstice product line. Additionally, the company surpassed its 2024 targets, doubling its goals for emission reduction, renewable energy deployment, and achieving energy management standards. The company is dedicated to social responsibility through its diverse workforce, community outreach, and workplace safety. Despite operating in the high-risk defense industry, the company engages with stakeholders to address concerns and maintain ethical business practices. Its diverse board of directors provides qualified leadership expertise and strong governance, with 83% independence. The CEO's compensation is 91% variable mix, ensuring executive incentives are strongly aligned with company success. Additionally, our evaluation of managerial entrenchment reveals Honeywell upholds robust shareholder rights.
Honeywell's growth will come from 3 key tailwinds: strategic portfolio management, innovative technologies, and reinvesting strong returns. After pressure from Elliott Management, Honeywell's decided to separate into 3 distinct companies: Honeywell Aerospace, Honeywell Automation, and Advanced Materials. With a strong track record with spinoffs, the company is well positioned for this transformation. At the same time, the company is aggressively expanding through acquisitions, making over $10 billion in deals in 2024. These acquisitions have already added over $800 million to revenue. Honeywell is also strengthening its presence in high-growth regions like India, further diversifying its portfolio. With India's projected GDP growth at over 6% annually over the next 5 years, the country presents a significant growth opportunity. India's aviation sector boasts a 12% CAGR with over 1,200 aircraft on order. Meanwhile, Honeywell continues to lead India's automation sector and is actively advancing projects to capitalize on its 14% growth. By 2026, Honeywell aims to generate over 25% of all revenue from India and other high-growth regions, reinforcing its global expansion strategy.
Honeywell is also driving growth through software innovation. Since 2019, Honeywell's connected enterprise segment has achieved a remarkable 16% CAGR, fueled by the rising adoption of software as a service and subscription models. With over 100 million buildings and 90% of global aircraft, Honeywell is unlocking additional value by integrating add-on software through recurring revenue streams. AI innovation is central to this growth, powered by Forge, Honeywell's IoT platform, which connects with over 100 million assets and generates revenue through subscriptions, licensing, and support services. This data advantage and integration reinforces Honeywell's leadership in the forefront of IoT-enabled, AI-driven solutions. Looking ahead, Honeywell's Quantinuum, the world's largest quantum computing firm, is developing quantum software to help train AI models. Strategic partnership with leading tech firms highlight the commercial viability of these products, reinforcing Honeywell's strategic leadership at the forefront of next-generation technologies.
Honeywell has consistently delivered strong financial performance, maintaining an average free cash flow to EBITDA ratio of 58% over the last 5 years. This highlights the company's ability to convert earnings into cash, supporting continued capital deployment. With revised projections now estimating up to $40 billion in capital deployment from 2023 to 2025, largely allocated towards acquisitions, Honeywell is well positioned to drive further growth. The company's return on invested capital has outpaced its WACC by 7% on average over the last 5 years, demonstrating Honeywell's ability to generate attractive returns on investments. In addition to expansion, Honeywell remains committed to long-term shareholder value, proven by 15 dividend increases in the last 14 years and a 15% share count reduction since 2017.
To reach our 12-month target price of $219, we develop a weighted average scenario analysis utilizing a DCF analysis with both EV to EBITDA, exit multiple, and a perpetual growth rate approach, as well as EV to EBITDA and PE relative valuations and a sum of the parts valuation, combined with a projected 2.3% dividend yield implies a 16% total return. In our base case, we expect service revenue growth to outpace product revenue growth, coupled with stable aerospace growth in 2025, driving a 6.4% CAGR over our forecast period. Margins are projected to rise from 38% in 2024 to 42% in 2028, supported by portfolio optimization, a shift toward higher margin service revenue, and Honeywell's recurring revenue model. Our DCF analysis utilizes an EV to EBITDA of 15 times, in line with industrial conglomerate peers, and a perpetual growth rate of 3.5%. Our relative valuations apply a PE of 23 times and an EV to EBITDA of 16 times, lower than Honeywell's current and 3-year average multiples. While they're in line with the 3-year averages of its industrial conglomerate peers, they are below the 3-year averages of many of Honeywell's segment-specific peers. With Honeywell's conglomerate structure, we also develop a sum of the parts valuation to offset value suppression. We individually value the aerospace, automation, and energy solutions business units using segment-specific EV to EBITDA multiples, as well as segment profitability and investment assumptions. This yields an implied 16.6 times EV to EBITDA multiple. Our recommendation is robust using more conservative growth rates, margins, and multiples. We have also incorporated a post-Liberation Day steady state and potential downturn case. We believe that our conservative valuation framework provides upside potential with limited downside risk.
As the company navigates various risks and implements mitigation strategies to maintain stability and future growth, its global supply chain faces disruptions that could affect cost, profitability, and production, though its diverse material and supplier basis reduces potential negative risk. Unsuccessful acquisitions in a large company can be detrimental, though past portfolio management has proven its ability to sell or spin off divisions. Expansion into high-growth regions like India is inherently risky, though the company already has an established global presence that reduces movement risk. We reiterate our buy recommendation for Honeywell with a target price of $219, representing a 14% upside and a 16% total return. Portfolio optimization, strategic reinvestment to future growth, and strong commitment to returning shareholder value makes Honeywell a compelling investment. Thank you.
Thank you. Judges, you may now turn on your video if you haven't done so already. The Q&A portion will be a minimum of 10 minutes and a maximum of 15 minutes. If there are no additional questions from the judges after the 10-minute mark, I will end the Q&A. Time will begin once a judge speaks the first word. Feel free to begin.
Adrian, thank you, and Appalachian, great presentation. Some initial thoughts and questions. So I know one of the discussions area was the key risks, and you talked about supply chain and so on, and global expansion. What thoughts do you have in the current context of tariffs and supply chain disruptions?
Yeah, of course. We've definitely thought about this, and we're very interested on India or how Honeywell is going to handle this. So we did a lot of research into India. If we could go to the appendix slide, east or 87 to east. So Honeywell has this great network and the kind of opportunity that they've provided themselves with, kind of giving themselves the manufacturing base and their supply chain network within India, China, and other places that may be getting tariffed. And so this is a great way to kind of avoid these tariffs and more of an opportunity to just deal with it within the country, not have to ship it outside of the country. The only thing that might be able to affect them is with indirect tariffs, with bringing in goods that were manufactured in the country that had to bring parts from outside the country.
Right. And what is the, like, as you think about the conglomerate structure, what sectors are you thinking will impact it most?
What structure was that? I'm sorry.
As you think about the conglomerate exposed in different business segments, which segment do you think will have the largest impact from supply chain disruptions?
Yeah,
The largest impact.
I believe that the aerospace industry will have the most impact. However, they're able to manage this the best as well with multiple sourcing products. So they manufacture most of their products in America and sell to American companies. However, there's some clients overseas in Europe that would have, if reciprocal tariffs do affect them or are implemented, these would be impacted directly. Automation is pretty secure in this section as the tariffs are meant to bring jobs back to America. This will actually increase automation sales as more companies are coming back to America. The high labor costs associated with this will actually increase the automation, industrial automation sector. So we see automation as a positive in these tariff talks. And then energy, the Americas is only 50% of their sales. So when you go overseas, the European nations have the European climate law, which requires them to have 55% carbon emission reduction by 2030 and a zero net carbon by 2050. That's on slide 215 or 212, I believe. And these are mitigation strategies for Honeywell and their energy solutions business. So these are aerospace has the most downturn because these other industries are so insulated.
Thank you. I do have another question, but I'll let the other judges go and then I'll catch up if there's time. Thank you.
Yeah, thank you guys. Good presentation. I guess my first question is just on the valuation. So you have is that a 16%, 14% upside? So 14 plus 2% on the dividend yield. Just getting to understand the presentation and the story behind this company, it seems like there is more good to speak about in terms of obviously what you have presented. But do you think, before I get into the details of the valuation, do you think a 14% upside is a fair presentation of the strong story that you have for this company?
Yes, I do. So originally our valuation, let me go to our valuation really quickly. So originally we had a $238 target price. This was pre-Liberation Day. The company gave great expectations for the year. We had very strong feelings, especially about the aerospace segment. However, post-Liberation Day, we realized that tariffs are a potential risk to our valuation. So we developed two more cases, which was a weak recession case as well as a deep recession case. And this is just reflecting just market concerns overall of a potential recession. Even though we do see the 90-day pause, this is taking into account that we believe, after 90 days, this will still be a significant factor to our valuation. Originally, we had a much higher upside. However, we believe that taking a more conservative approach and just looking at how the market is currently doing, as well as our expectations for general GDP growth, kind of, I guess, reduced our expectations for the year.
Okay. I think that's a fair point, and it's good to see that you guys are obviously, on the ball, things that are happening, because some of the things you're mentioning just happened yesterday. So that's very key as well as you look into your valuation. But if you were to tell us any among the assumptions that you made into your valuation, which one would you consider the biggest assumption, and that probably gives you a little bit of a worry? And how did you get around that assumption in your valuation?
I think the biggest assumption that we made in the beginning was that margins were going to be rising. And this was largely due to the shift toward higher margin services versus products. However, since there is this potential of tariffs, we had to reevaluate, and actually we increased our cost. Well, in our base recession case, which is the weak recession case, we had the cost of products remaining stable, even though in our more bull case, cost of products was going down every year. And then in our deep recession case, we had the cost of products significantly higher just to reflect the potential of tariffs.
Okay. Yeah, thank you. I'll pass on to the other judges.
Okay, thank you for the great presentation. I enjoyed very much. So that I know that there's so many details that has not been covered. So if you don't mind that I think I just have one question because I don't think that we have much time, is that you mentioned in the slide and said that the acquisition added a lot, like 800 million revenues for the Honeywell. So how could you incorporate that into your cash flow projection? The acquisition, because you said it's the biggest add-on value to the Honeywell future growth, right? So how would you incorporate that into your cash flow projection?
Yeah, so we do expect their cash flows to keep growing. If you could go to try slide 140 for me, please. Yeah, so one of the things that Honeywell has made clear is that they wish to convert as much earnings into cash as possible. Their goal is 100%. I think it's by the end of 2026, I believe. So they're targeting acquisitions at the moment that they consider bolt-on acquisitions. These are just kind of more simple targets that just can clip right onto any of the segments they wish to add on to. And because of that, it's going to be hopefully accretive as soon as possible. The other reason they're doing bolt-on acquisitions is just to make smooth operating. So for the free cash flow, we hope that it would be additive, and the resources that Honeywell already has will be able to transfer easily to these new acquisitions.
Okay, so it is how many years did you do the projection? Because currently in the slide, I cannot see how many years did you do the projection?
Yeah, if you
5
could go
years, 10 years, how many years?
try the future free cash flow on 149, please. So we projected all our forecasts were out until 2028. So it's about a 5-year when we started this model. And we continue to increase the cash flow projection because that's what we believe these acquisitions and Honeywell's path will increase. If you could go to the next slide as well, please. So this is a breakdown of where those increases in free cash flow comes from. The biggest thing that's been additive to them is switching over to services, and some of their acquisitions, I believe, are adding to that as well for the service side. So the historical, if you see the last 3 years, we haven't increased too much, but we still have cash flows growing in proportion to historicals.
Okay, thank you.
Okay.
If there's time, I'll step in with one more question. As you think through, going back to the overall conglomerate structure, and each of the exposures from the relevant industries, which segment are you thinking will be the largest growth factor for Honeywell?
We believe, looking at this, their aerospace is going to be their largest growth factor. Could you go to 76 for me? So with aerospace, we're really excited about what future contracts they have, and they have a really big backlog, which we believe will also protect them a little bit from these tariffs that are in place, but paused for right now. But if they do get resumed in 90 days, we could see this backlog carrying their aerospace through this harder time. Also, we believe that around the globe that the air forces and commercial air companies are looking to expand their fleets. So we could see a lot more demand for aviation, which like commercial, like new equipment may not be Honeywell's biggest segment, but we can look at their aftermarket. So repairs on products, that's kind of their biggest segment in aerospace.
Got it.
On top of aerospace, their company is also an expertise in the drone market. They have expertise of patents and hydrogen propulsion and all these things, which with military applications is a huge thing with projections from 2 million to 6.5 million by 2030, as well as Honeywell having commercial applications for this. The CEO calling it the robo-taxi of the skies. So the commercial applications for these drones is immense, and they have a large expertise in this area.
Perfect. Thank you. No more questions from me.
I know from yesterday, guys, I think it was Delta Airlines or so who couldn't give, sort of like proper guidance just because of the environment that we are in. How would you have sort of like gone around, clientele base and obviously we're talking of segments and product here, but if some of the bigger buyers cannot even tell what the future is going to be, how does that play back to sellers like in this case, Honeywell?
If their client base is unsure about the future, not willing to spend, is that what you're asking? Kind of like their client base not being willing to spend?
Yeah, unsure or unwilling to spend, yeah.
We understand that, and we've definitely looked into that with our valuation. But with especially aerospace, we understand also that airplanes still need maintenance and be fixed, which is already a really big part of the aerospace segment. So we're pretty optimistic about aerospace and military contracts still coming in due to these restrictions on airplanes. Also, there are other segments. We believe that there's a lot of investment that we've already seen in the United States. So we believe our Honeywell's automation segment is going to take off due to these new factories being built in the U.S. So spending there is something that we're excited to see. If Carson has anything else to say about this, I'd love to.
Yeah, predictive maintenance with the IoT platform is essential to businesses. So when they have this IoT platform that have the assets connected to each other, they have the ability to have predictive maintenance that doesn't allow for downtime in their manufacturing plants. Companies are not willing to skip out on this. This is a crucial part of their business. This is in the industrial automation plant. And then, as I mentioned earlier, in the energy solutions business, there's regulations in place that are going to make companies spend the money even if they don't want to. So the energy is insulated in this aspect, as well as the building automation, where you have the most efficient buildings, that their software programs that we're expecting to see more growth in. These are essential to businesses to have the lowest energy output. If they're looking for cost, they're going to save money by buying the software to lower their cost and energy output and efficiency, as well as managing the people flow through the building. This is crucial for these businesses.
Can you touch a little bit on the ESG side? I'm not sure if you touched it already and I didn't just grasp that, but can someone just talk a little bit on the ESG for this company for maybe 30 seconds?
Absolutely. The company has a diverse workforce across. Kira, if you could go to slide 124, please. They have a diverse workforce all around. And additionally, if you click on the next slide, you see a diverse board of directors. So we are seeing not only diverse qualifications, but race as well. The company, strives to bring knowledge and ideas and expertise from all different areas. Additionally, with their social responsibility, they do a lot of work in community volunteering and trying to uphold a good face of the company and good morals across the board.
Okay. And on the E?
The E, one of their most important, their greenhouse gas intensity. Kira, I have a slide for that. If you could go to, they've been significantly reducing their greenhouse gas emissions. If you go to, right there. Since 2011, they have decreased, I believe, about 84%. This is scope 1 and 2 intensity. They're also developing something called their Solstice product line, which increases carbon emission efficiency. So these are used.
Time. Thank you, Appalachian State University. At this time, the judges will take a few moments before the next university is brought in. Thank you all.
Thank you.
Thank you, guys.
Thank you.
Thank you.
Welcome, Babson College. Please launch your presentation and make sure everything is working properly.
Good afternoon, CFA Institute. My name is Khadija, and I'm here with Shane, Felipe, Arnav, and Daniel, and we're all very excited to present to you this sell opportunity. Today, we're pitching HubSpot with a sell recommendation and a target price of $409, representing 18% downside as of April 4th.
The CRM industry is highly penetrated, with 91% adoption among companies with 10 or more employees. Two key segments dominate the market: small and medium businesses, SMBs, which prioritize clear ROI, and large enterprises, which seek customization and data-driven insights. Salesforce holds 22% market share alongside enterprise-focused Microsoft and Oracle.
Founded in 2006 as a marketing tool, HubSpot has evolved into a small and medium business-focused CRM. Recently, its lower-value starter customers have outgrown its higher-value pro and enterprise customers, causing its average subscription revenue per customer, or ASRPC, to dilute, which has led the company to attempt to move upmarket. As the company has scaled, its EBIT margins have reached around 17%. HubSpot offers software through its 6 hubs and through add-ons. Its pricing is quite dynamic as it offers different hubs and tiers, ranging from $15 per month for the starter tier to over $4,000 for the enterprise tier. HubSpot also follows a land and expand strategy, which is basically acquiring new customers and increasing the wallet share of their existing ones. Another important thing to understand are the solution partners. These are external agencies certified to sell, implement, and support its CRM. They contribute to 46% of the total HubSpot's revenue and are responsible for onboarding 75% of the pro and enterprise clients.
Great. So following the pandemic, remote work trends during COVID led to greater CRM adoption and a strong run in HubSpot stock. However, in 2022, an inflationary environment and constrained IT budgets for SMBs led to a downturn in the share price. And then since 2023, AI excitement and potential upmarket expansion has driven investor optimism. However, rising competition and unclear AI use cases have been underestimated. And since we initiated coverage in early February, the stock has come down 35% as our catalysts have begun to play out and the broader macroeconomic environment has weakened.
Moving into our investment thesis, HubSpot's upmarket shift will be unsuccessful. To evaluate HubSpot's success appealing to larger enterprise customers, we conducted a wide range of primary research, including conversations with 120 solution partners, or nearly 8% of the entire network, as well as 5 non-executive employees, 10 competitor employees, and 15 industry experts, as well as attending a CRM conference. Our research revealed 3 roadblocks for HubSpot to move upmarket: product limitations, solution partner service gaps, and high industry penetration within the sticky enterprise market. Our research indicated enterprise customers require their CRM to provide a high degree of customization, specialized industry features, and advanced AI and data management tools, all of which HubSpot is significantly lagging their competitors in and are huge hurdles for their sales team and solution partners to overcome in the selling process. Second, solution partners lack the experience and specialization needed to onboard these enterprise-level clients. Our research shows only 22% have worked with enterprise-sized customers, and a lack of specialization was highlighted in both our research and industry thought leaders. Only 70% of partners focus on marketing services, and unlike the market leader Salesforce, most partners are generalists, making it difficult for them to meet the complex needs of larger clients.
Third, the upmarket shift will create friction as enterprise-level CRM installations are rare and involve long, complex implementation. This challenge is amplified by high CRM penetration, with 90% of Fortune 500 companies already using Salesforce as their preferred solution. Our research leads us to projecting pro and enterprise customers growing at a slower 8% CAGR through 2029, with a larger number of starter customer additions diluting total ASRPC over the same period. Consequently, we estimate land revenue growth will slow to nearly 7% by 2029, short of analyst expectations.
So moving into our second thesis, we believe HubSpot's net revenue retention targets are unattainable. So HubSpot measures expand revenue through net revenue retention, which tracks changes in monthly recurring revenue over time, factoring in add-ons like hub upgrades and other upsells. Now, during the pandemic, NRR jumped to 115%, but aggressive overselling has caused it to drop back to 103%. We expect NRR to be 102% in 2029, while the street expects 110%, driven by AI adoption and monetization. Now, looking ahead, we believe the four historic drivers of NRR have weakened. Initial hub overselling and a growing price gap between tiers will reduce the impact of cross-sell and upgrades. While management expects strength from marketing contracts and seat adoption, we also see less impact from that as AI tools improve user efficiency. Now, HubSpot is also falling behind competitors that offer free AI agents, and by year end, Salesforce plans to hire over 1,000 dedicated AI salespeople, only intensifying the competition. To reach management's ambitious NRR targets, AI would need to contribute over $3,000 in ASRPC by 2029. However, our primary research indicates that HubSpot's AI tools currently have limited impact on user experience and have failed to drive any meaningful wallet share expansion. So our NRR forecast is 8% below the street's expectations, driven primarily by lower AI monetization, leading to a projected $530 million revenue shortfall and a 9.5% cumulative downside versus consensus.
Now, looking at this history, HubSpot's attempt to shift up market comes at a cost. SaaS companies leverage economies of scale, distributing fixed costs across a growing customer base. And HubSpot has followed this trend, but moving forward, we expect this to slow, contrary to the street's more aggressive assumptions. So first, HubSpot's customer acquisition cost is currently at 2.3 times. However, our primary research indicates that its upmarket shift will require a larger as well as more specialized sales force. And we also expect a slowing ARR growth, which will drive CAC to 4.1 times, closer to Salesforce 4.4 times, resulting in a higher sales and marketing expense than the street expects. And secondly, the market assumes AI development, but underestimates the associated costs. We believe that AI will be a required expense to remain competitive. However, enterprise competitors outspend HubSpot by more than 8 times. So we expect a 20.5% R&D margins versus the street decreasing it. So the higher CAC and sustained R&D are expected to push EBIT margins to 21.5% in 2029, which is 3.6% below the street expectations.
For ESG, we conduct our own analysis, factoring in our primary research to help derive an ESG score. We recognize that HubSpot performs average compared to its peers. However, using a framework in line with MSCI, we believe the score should be 5.8 compared to MSCI 6.1. We are mostly aligned with the social and environmental components, which together represent 60% of the total MSCI ESG score. A small divergence stems from the fact that there is limited diversity in leadership and technical roles. However, our main difference is on the governance score. Our analysis considers factors such as compensation being heavily tied to the stock performance, board independence, and most notably business ethics, because recently HubSpot's management went back on their promise to solution partners of maintaining their compensation structure. And our primary research shows that 77% of these solution partners have been impacted, and we have factored ESG into our valuation.
So for our valuation, we applied a 50-50 blended approach to intrinsic valuation and relative valuation, which resulted in a target price of 409, reflecting an 18% downside. And several factors drive the intrinsic valuation. First, revenue growth is fueled by customer growth, which includes starter and pro plus tiers clients, and a stagnant ASRPC growth, resulting in an 11.2% revenue CAGR. We also model a 4.1% margin expansion until 2029. And using as an exit multiple 7.5 times, a WACC of 11.6%, as well as factoring in 2% share dilution from the stock-based compensation, we arrive at a price target of $397, implying a 21% downside.
For our relative valuation, we applied a 50-50 blended approach, segmenting into two peer groups, high-growth software companies and enterprise CRM competitors. We chose to value HubSpot on an EV to sales basis due to investors focused on revenue and large differences in profitability and capital structures across the software sector. On the left, we benched the high-growth software peer group based off of revenue growth and margins, leading to an EV to sales multiple of 7.1 times. On the right, we applied an 110%
1 minute
to the
remaining.
average CRM competitor multiple, down from 131%, reflecting HubSpot's slowing growth in alignment with this peer group, resulting in a 7.3 times EV to sales multiple.
We foresee three main risks to our valuation. HubSpot would benefit from larger IT spend. However, established budgets and market uncertainty is likely to keep spending low. Accelerated AI monetization and growth up market are unlikely to materialize as market leaders maintain a large edge over HubSpot. Since February 12th, HubSpot stock has fallen over 32% as catalysts have played out. Looking ahead, the next upcoming catalysts include quarter one earnings, which will give more visibility on NRR drivers and customer mix, alongside Salesforce earnings, reflecting AI adoption trends within the industry. We believe HubSpot is losing leads, and now is the time to sell. Thank you, and we are happy to take any questions.
Thank you. Judges, you may now turn on your video. The Q&A portion will be a minimum of 10 minutes and a maximum of 15 minutes. If there are no additional questions from the judges after the 10-minute mark, I will end the Q&A. Time will begin once a judge speaks the first word. Feel free to begin.
Thank you. I can kick this off. So great presentation. Your thesis argues about HubSpot's upmarket strategy will fail due to product and partner limitations, right? But given that HubSpot is actively investing in AI and platform expansion, how would you assess whether these initiatives could materially shift your enterprise adoption in the next, 3 to 5 years?
Absolutely. Felipe, if you could go to slide 77, please. Yeah, so we basically think of AI in two buckets. One is agentic AI, which is going to be sort of the core driver of AI adoption within the enterprise space. And then there's also other types of use cases within AI as well. So if we're thinking about agentic AI, and obviously you mentioned that HubSpot is attempting to move up market, it's only fair to compare them to other enterprise players. So if we're thinking about a Salesforce or an Oracle, both of those companies already have free AI agents available on their platform. And Salesforce plans on hiring nearly 1,000 new AI salespeople this year. Oracle plans on adding 150 AI agents to their platform. HubSpot currently has no monetization, and they haven't added any AI agents to their platform yet. So clearly they're significantly lagging behind established enterprise players within this market. And so it doesn't really create a very compelling case for an enterprise, a larger company, to pick HubSpot over those two players. And then if we're thinking about our sort of primary research really briefly here, we had the opportunity to speak with over 100 solutions partners. Like within the core SMB base, even those companies were telling us that the AI that HubSpot has on the platform hasn't had any meaningful impact to their business when they've adopted it, and it's way too expensive for them to actually adopt as well. So that's sort of driving our conviction in the fact that AI won't have any material impacts.
Got it. Another question, and I'll pass the mic along. You talked about net revenue retention target of 110 is unattainable. Can you expand on how your assumptions about seat consolidations and AI efficiencies directly conflict with management's projected NRR?
Yes, of course, I can take this question. So as you mentioned, we have a projected NRR of 110%, which is mainly driven in our side by AI. So it's contributing 0.9% for AI. However, the street expects and management a 5.1% increase in NRR due to AI monetization, which is coming from new customers adding in AI into their platform, into their clients, as well as marketing. However, we believe this is not on the table because, like Arnav said previously, they are lagging in AI against the other enterprise competitors. So they're not going to drive any meaningful AI monetization, which will drive their NRR to 110%. We believe it will be 0.9%. In addition to that, the previous NRR drivers like cross-sell, marketing upgrades, addition upgrades, and seat base are also weakening. Due to the fact, first, by a high upselling, when customers are getting in, they start with three hubs and then diminish to one hub because they don't need to use that much, as well as AI decreasing the number of seats they will likely to use. So we believe the 110 target is not attainable, as 102 is attainable.
Got it. Thank you. Good answer. I'll pass it on to the other judges. Thank you.
Yeah, thanks. Thank you, guys. Good presentation. It's always not easy to go, on the sale recommendation, but I think you probably did a good amount of work there to show us why you think this is a sale. First question is there any expectation of a buyout for such a company? And if so, how would you have incorporated that in your valuation?
Sure, I can take this question. Felipe, could you go to slide 48, please? Great. So around May of 2024, there was actually a potential buyout of HubSpot by Alphabet. And going into July, the deal actually fell through. It's important to note that HubSpot is a very large company, about $27 billion in market cap. And so we don't foresee any potential acquisitions of this company going forward, but more so organic growth through the company's main M&A pipeline. If we could just go back, Felipe, to the appendix and go to slide 53, I'll kind of talk about some of the acquisitions that they've made in order to continue this organic growth rather than get acquired from bigger companies. So HubSpot looks to acquire companies through a bolt-on acquisition strategy. So acquiring companies that can currently complement a lot of their product suite. Back in 2023, in December, they acquired a company called Clearbit, which has largely been used to build out their Breeze Intelligence platform. While this was the largest deal that they've kind of done over the past couple of years, this platform, Breeze Intelligence, does not directly contribute to any AI monetization on the top line. So we foresee more organic growth for HubSpot given its size, contrary to a bigger buyout from a larger firm like Alphabet.
And just to add a little bit onto Shane's comments there, also recently, following the Alphabet potential acquisition, management's commented on it over the last 6 months and talked about how they're really pivoting and they really believe moving forward they want to follow just an organic growth and they're not looking to be acquired anymore. And as Shane mentioned, the size of HubSpot's $27 billion. So we see not very many potential suitors for an acquisition of that nature.
Mm. And that's good. Let's go back to the valuation. So I know you did a 50-50 on the relative value, and I think the one that incorporated the DCF. Any basis on the in terms of just the 50-50? What was the thought process behind it?
Yeah, that's great. Thank you. Felipe, can you please flip to slide 102? So I can kind of walk through the relative valuation in our approach and why we chose a 50-50 blended approach. So first, we chose high growth SaaS companies as a comparable because often sell-side analysts and buy-side analysts are looking at this company in comparison to other higher growing software companies. So we chose to make a peer group aligned with those companies and look at their valuation in terms of other higher growth SaaS companies. And we believe due to this, when benchmarking them based off of revenue growth and EBIT margins, we realize that HubSpot trades at an unjustifiable premium compared to these companies. Now, Felipe, if you flip down 2 slides, can you please go to the enterprise one? Now, looking at our enterprise relative valuation, we believe as HubSpot aligns closer to these enterprise companies trying to move up market, they'll be valued alongside them closer. Now, we believe this is important to note as HubSpot's slowing top line growth due to a lack of ability to move up market and their inability to meet these net revenue retention goals. We believe that they're going to trade closer to that 110% premium, which they've traded like in the past in April of 2024 as well as in 2020. Now, we also believe that some of the core drivers for these, or we also believe that some of the core drivers of the premium as well involves the margin profile. And we believe HubSpot's margins won't be able to get to the profile of some of these larger enterprise companies due to the first mover advantage and their small scale. So we chose to blend these as a 50-50 approach because we believe investors on both sides are looking at other CRM competitors, such as enterprise competitors, as well as higher growing SaaS companies.
Okay, thank you. I'll pass on to the other judge for now.
Thank you. Would you mind that switch to the DCF analysis slide? Okay, thank you. So I'm interested in like some specific detail. So yeah, I think that the 32% growth rate is based on historical situation. And then how could you guys that predict I think it's net revenue and EBIT margin, and then how could you predict the growth rate for the next 5 years?
Of course, great question. I can take that one. So if you go over here to revenue build, we can basically see what's driven our revenue. So it basically 98% of revenue comes from subscription revenue, which is starter and pro customers. as well as their wallet share, the ASRPC growth for each of the customers. So as we mentioned on thesis one, we believe that the Pro Plus customers are going to decrease over the following years because HubSpot won't be able to move up market. And in addition to that, we also have the street implying an increase in AI spending for the customers, which will increase the monetization from AI, which will lead to higher ASRPC than we believe. So we believe that ASRPC would be basically flat over the next couple of years, as well as customers for Pro will decrease, which will lead to a 12.8% growth in 2025, going to 9.9% in 2029, which is an 11.2% CAGR by the intrinsic valuation.
And just to add on there, when we're talking about revenue, I think it's important to talk about solution partners as well, because they bring in like 46% of the revenue. And recently, when HubSpot changed their policy about compensation structure for these solution partners, our primary research showed that 77% of the solution partners have been impacted with it, and they have been disincentivized to work as hard and cross-sell as they were doing before. So these are some factors that we took into consideration.
Okay, thank you. And my last question, let's do about the cash flow projection, because that is the basis for your DCF. So other than the revenue, I think that you spend a lot of work on that about the revenue projection. So other than the revenue, what other factors or variables do you think is more important or sensitive to have an effect on your cash flow projection?
Of course. Yeah, as we mentioned, margins also have an effect on cash flows, and specifically the free cash flow. As we believe that the margins will be 21.1%, 21.5% in 2029, and that's basically driven by increased spend in R&D coming from AI spend. So if they want to incorporate AI in their platform, they will have to increase R&D, as well as then increase our personnel in sales and marketing, their sales force, to try to move up market. But as this won't be successful, their margins are not going to increase to 25% as the street and management expects. In addition to that, they have pretty much we have the same expectations of D&A as well as CapEx and net working capital as the street. And we, in addition to that, we also conducted a per share analysis because we believe that the share dilution coming from stock-based compensation, it is relative and it is a lot. So we basically have a 2% dilution year over year, which leads to a 21% upside to the DCF within the free cash flow.
Okay, I have no further question.
I have one. So in your research, you interviewed, as you said, solution partners, current and former employees, and competitors, right? So what was the most surprising or contradictory insight that you encountered during this process, and how did that shape or challenge your thesis?
Yes, Felipe, can you please flip to slide 68, please? So yeah, as you mentioned, we did a lot of research and talking to these solution partners because they account for 46% of the revenue, as well as 75% of the onboarding for Pro Plus customers. And then in total, we were able to reach out to over 120 because we spoke to 20 recently. And then, like as you mentioned, we also spoke to kind of a larger blend through industry experts, HubSpot non-executive employees, and competitor employees. I think the biggest realization that we had with the solution partner network was that these partners are really non-equipped to service the enterprise level customers. Because HubSpot originated as a marketing platform in 2006 and maintained that structure for 10 years, the partner network really developed around the marketing tool. And now if we look across the focus of these partners, over 70% of the partner network are focused on providing marketing solutions. So they don't have a technical expertise on coding and adding in complex integrations that these enterprise customers require. They focus on providing marketing solutions like marketing campaigns and social media content and management, which really doesn't align with the full suite of CRM. Now, HubSpot's become a full suite of CRM in the last few years here recently, since 2021, having the sales and service hubs and operations hubs, but really their solution partner network is more towards a marketing tool rather than a full CRM suite. And we think this is a huge, there's a huge lack of organization between what the solution partners need to do versus what they're capable of.
Also, just to add, so when we were started our interviewing solution partners, we went with an open mind. And one thing that we found, like contradicting what to management claims, was that listening to management commentary, we found out that they said that their AI is doing pretty well and they see a good adoption in it. But when we talked to our solution partners, we found out that only 5% of them said that their clients are actually using AI. So that was one finding that we found was contradicting to what management claims.
And then I'll just quickly add a point on industry experts. So we actually reached out to about 10 industry experts as well. Felipe, could you go to the appendix slide 39, please? So I actually had the opportunity to attend a CRM conference by invite down in Atlanta.
That is time.
Late January.
Thank you, Babson College. At this time, the judges will take a few moments to collect their thoughts before the next university is brought in.
Great
Thank you all.
presentation. Thank you.
Thank you, guys.
Thank you.
Hello, everybody. We are Power and Value team from Argentina. We're very excited to guide you into the journey of Pampa Energia, an Argentinian energy company with a diversified portfolio and strong fundamentals, but still overlooked by the markets. That's why we issue a buy recommendation at $68, targeting $88 per share. This 29% upside is based on the next 3 investment theses. First, Argentina's rapidly improving macroeconomic environment. Over the past decades, Argentina's economy has been facing persistent economic instability and faced several failed reform attempts, including the last one in 2015 by former President Mauricio Macri. However, since the new government of Javier Milei has taken office, bold new measures have been taken to stabilize the economy, primarily through the Basis Law, which aims to promote long-term economic stability. And already the results speak for themselves. As the country's risks have been reduced to a 5-year low, inflation rate has dropped from 20% to only 2% per month, and an overall more investment-friendly environment has emerged, creating new opportunities for business like Pampa. Second, a T-shaped portfolio. But first, what do I mean by this? This means that Pampa is an integrated business, meaning that it dominates both the midstream and the upstream. The midstream is controlled through subsidiaries called TGS that hosts 60% of all gas pipelines in the country, and through Transener, which controls 86% of all high voltage lines in Argentina. And then through its direct line of business, it controls 15% of the electricity generation and 9% of the gas market share. And if that wasn't enough, Pampa has recently shifted its focus towards shale oil, beginning production at Argentina's energy crown jewel, Vaca Muerta. This formation has a productivity and reserves only comparable with those at the US Permian Basin. With the recent acquisition of Rincón de Aranda, a block strategically located amongst the best performing blocks in Vaca Muerta, Pampa will significantly expand its oil production, not only becoming a top player in this sector, but also diversifying even more its current portfolio. Third, stable cash flow generation. This is both gas and electricity are capable of generating stable and reliable cash flows. This is achieved through long-term power purchase agreements and through gas supply agreements. These contracts are denominated in US dollars, which not only mitigate currency risks, but also provide predictable cash flows for more than 15 years.
Let's dive into the numbers. When it comes to the generation segment, Pampa has a consolidated leading position, being the second largest producer only after the government. At an industry level, growth is limited by restrictions on the availability of new transmission lines, but PPAs ensure ongoing business. The gas sector faces similar characteristics, but Vaca Muerta's development has introduced the long-term potential of liquefied exports. Pampa has taken a leading role to build the infrastructure needed to position Argentina as a major LNG exporter with twofolding current output. This remains a long-term opportunity. Looking forward, cash flow from these segments will partially fund the shale oil project in Rincón de Aranda, with capex needs totaling $1.5 billion, mostly concentrated in 2025 and 26. This investment is expected to yield strong results, growing consolidated EBIT towards 20% annually and becoming 50% of operating income by 2028. This is the result of economies of scale and efficiency improvements, gradually improving profitability, following an industry standard learning curve similar to the case of Vista, an Argentinian company that started its shale oil operations in Vaca Muerta a few years ago and represents the most comparable case.
We are now going to discover Pampa Beyond the Numbers, a company committed to meet 8 of the United Nations sustainability goals. Pampa's ESG profile reflects opportunities in the environmental front, but strong social and governance practices. Starting with environmental, thanks to Pampa wind farms, carbon intensity is well below the global average. However, the company's shift to oil adds pressure to its carbon footprint and lacks clear carbon reduction targets. This represents an opportunity for the company to better align management incentives to sustainable outcomes. Regarding social, Pampa has been the only Argentine company included in the Bloomberg Gender Equality Index, with women representing 40% of the board. Furthermore, safety programs have reduced lost time incidents by over 30%, and surveys show that employees are very likely to recommend Pampa as an employer. Finally, in governance, the company has a notable board independence, with 50% independent directors. Additionally, management's equity stake has grown to over 25%, reinforcing confidence in long-term value. Pampa's ESG performance, summarized through our internal scorecard, achieves a combined sustainability score above the peer average. While strong social and governance practices help, they do not fully offset environmental risks, and given the company's growing exposure to oil and the lack of emission targets, we applied a 56 BPs ESG-related increase to the cost of equity. Even with this adjustment, our valuation supports a buy recommendation, though with a more cautious stance on long-term sustainability risks.
Now, moving on to valuation. Our analysis employs a sum of the parts approach combining DCF and relative valuation. Given Pampa's consolidated competitive position, we apply the Goldman Sachs model for the cost of equity, as it best captures country-specific risk in emerging markets. However, shale oil presents a different risk profile due to Pampa's limited experience in the sector. To reflect this, we reference Vista cost of equity in 2019 when its oil field were at a similar development stage to where Continental is today. We adjusted for current country risk plus the ESG premium for the shift from renewables to fossil fuels, reflecting the downgrade in the environmental profile. The cost of debt follows the average yield to maturity of Pampa's current traded bonds, with the simulation modeling the risk-free rate. All of these arriving at the 15% WACC, which was further stressed in the scenario analysis. Given the unique characteristics of each business unit, we analyze and forecast them individually. For generation, we analyze the power purchase agreements for each plant, evaluating installed capacity, dispatch factors, and pricing structures. Terminal values assumes an 1.5% annual demand growth in line with expected population trends. For gas, local sales have been projected using fixed volumes at an agreed price according to Plan Gasar, as mentioned in our third thesis. Excess capacity is exported to Chile at a higher price. The residual value was determined using an EV to reserves multiple based on comparable companies. For petrochemicals, sales volume were modeled through a Monte Carlo simulation to capture uncertainty in the production level, while the prices were tied to the futures market. Given the long-term uncertainty and adopting a conservative approach, we assume a $0 residual value for this business unit. Finally, the oil segment is expected to reach a production plateau of 45,000 barrels per day by 2027, with improving margins as explained before. The pricing was made following current Brent futures prices, and the productivity of the block was based on neighboring fields. Like gas, oil terminal value was thought with an EV to reserves multiple. Lastly, for the subsidiaries, TGS and Transamer, we apply blended forward EV to EBITDA multiples adjusted by emerging market risk premiums under our base case scenario. Our analysis tested the sensitivity of key valuation drivers, including the risk-free rate, the country risk, and the oil segment performance. Combining all these three scenarios, we arrive at a price target of $88, representing a 29% upside from current price.
Now, I am going to conclude by speaking about risks. We begin presenting the risk matrix and noting that by entering into the oil business, Pampa is now exposed to new risks, international price volatility of oil, and the dependence on the midstream infrastructure. That being said, there is no risk carrying both high impact and high probability, which serves as a compelling argument in favor. Now, regarding oil price volatility, half of the oil production is expected to be sold domestically, a market historically more stable. This, combined with the D-shaped portfolio's diversification, helps to reduce the risk. Additionally, 65% of the oil production is expected to be hedged in 2025, and the company expects to hedge year by year, even though in Argentina there is a shortage of hedging mechanisms. Now, finally, referring to the midstream dependence. Given that Pampa's ability to transport oil nowadays depends on the existing oil and gas pipelines, in which Pampa holds limited capacity as it was now part of the original project, the ability to expand the production depends on the completion of Vaca Muerta South projects. However, Pampa has successfully achieved agreements with operators to acquire additional capacity, mostly mitigating this risk too.
And with all that being said, we would like to reinforce our buy recommendation based on the first three investment theses. First, the optimistic outlook for Argentina's economy. Second, the T-shaped portfolio with yet more value to be added at Rincón de Aranda. And third,
1
the
minute.
stable and reliable cash flow generation from both gas and electricity sectors. With all that, thank you for your attention. We're happy to receive your questions now.
Thank you. Judges, you can now turn on your video.
Thank you.
The Q&A portion will be a minimum of 10 minutes and a maximum of 15 minutes. If there are no additional questions from the judges after the 10-minute mark, I will end the Q&A. Time will begin once a judge speaks the first word. Feel free to begin.
Thank you. I can kick this off. Great presentation. So I have two questions. One is on your ESG. Can you speak a little bit about the corporate governance, the transparency, and overall the DEI initiatives, and how that's been factored in your evaluation?
Yes, excellent. So basically, the governance has played a really key role in the company's performance along the years. Historically, the company has been very transparent in their ESG reports and the earning calls. They've been providing a lot of information to the markets in order to help the retail investors to better understand the company. So the company is really committed to improve the transparency along the board independence and adopting more people with more capabilities to the board.
Right. Okay. Thank you. With regard to overall fossil fuel and the environmental implications, how are you factoring in, changing sentiments in the marketplace in your evaluation, particularly with people moving out of fossil fuel into more sustainable energy?
Yeah, we have penalized in our evaluation that fact because Pampa, as I mentioned before, has recently moved from renewable energies toward fossil fuel. So we applied based on an academic paper published in 2011 called Does Corporate Social Responsibility Affect the Cost of Equity? And in that academic paper published in a very reputable journal called Journal of Banking and Finance, they concluded and investigated more than 12,000 companies, and the result of that study showed that companies with a weaker ESG profile tend to have 56 basis points increase in the cost of equity during the WACC calculation. Therefore, as Pampa has made this move, we penalized the WACC by 56 basis points.
Great, thank you.
I may compliment. We penalize the cost of equity by 56 basis points, not the WACC. No, just that.
Got it. Thank you.
Good job, guys. So the biggest competitor here is the government, I understand. Is there a risk that this company could be nationalized?
In what sense? I'm sorry, could you repeat the question?
Is there a risk that this company could be nationalized in the sense that could it be taken over by the government instead of being a private company?
Okay.
Yeah.
Now it's the risk of that happening is practically marginal, as one of the main key points to invest in this company is the optimistic outlook for the economy, and current government of Javier Milei hugely respects private property, and it's not projected that this company is taken, it's privatized. I'm sorry, it's statalized.
I'm sorry, I might not understand completely your question. Maybe you are referring to the Argentine government is famous for having difficult regulations. You're referring to that environment in general?
Yeah, no, I mean, actually, the answer you gave me is what I was looking for, because I was just asking if there's a risk that this company could be taken over. Instead of being a private company, it could be converted into a government entity.
No, yeah. there is a great question for for a company like Argentina. Let me explain to you
Yeah, I
a
already
little bit
explained
more.
it.
Okay, I guess my next question is, so you guys did the sum of parts, right? So remind me again as you answer this question, how many parts you considered? I know you spoke about some contracts and you were using the contracts in terms of, trying to do your valuation. Speak a little bit about that and how you got comfort in terms of projecting, sort of like the future in terms of, I know your terminal growth was like 1.5. How also you came around with that number as well?
So
Sorry,
as I explained before, we did a sum of the parts approach, mainly because each business unit is very unique, and each business unit has different margins and different perspective to the future. For example, generation, as you mentioned, we assume an 1.5% annual demand growth. It is taken by the expected demand year to year of energy. And then, for example, like petrochemicals, we assume the $0 residual value mainly because the petrochemical business unit, it generates about 25% of total revenue, but it's only 2%, which is quite interesting. That's why we also assume a $0 residual value for that business unit. And alongside with that, the company guidance has hinted in the past that they are trying to get rid of that business unit because it's not profitable for them.
How many parts did you end up having in your sum of parts?
We did the evaluation for the 4 business units, which is oil, gas, generation, and petrochemicals, and the relative part of the subsidiaries.
Yeah.
And on the
we have used comparables with those subsidiaries.
Yeah. On the sum of parts, which part was the biggest, or which product was the biggest contributor to the valuation?
Well, as we can see in this chart, the generation segment is the one that represents the most, the majority of the price. This is a very stable segment because its revenues are USD denominated in dollars through power purchase agreements, which are take or pay contracts. And this segment not only is the core business of Pampa, but also is a really stable cash flow machine.
Yes, and in addition to that, around 70% of generation EBITDA comes from just 30% of its installed capacity, which operates under long-term dollar-denominated contracts, as we mentioned earlier, with an average duration of 15 years. So these contracts would account for approximately 270 million out of 360 million in total of EBITDA. So the result of this is that the reliable and stable cash flows we mentioned in our third thesis.
Okay, thank you. I'll pass on to the other judge.
Thank you.
Okay, good job, guys. So I just have one question, just following the previous chart, and you mentioned about the ESG factors. One of the, I think, the major social factors, other than you're talking about demographic structures, but also I think is very interesting is about at the beginning you mentioned that industry, the government, because your new government helped the economy get better in Argentina. So how could you? It is a positive factor so far, but how could be, the change of the government will make the inflation maybe worse? So how could you, assess that factors? And also, did you do the scenario analysis in your DCF analysis as well? I did not see it, but maybe I missed.
Yes, let me divide your question. First, about the stable cash flows. In our analysis, these cash flows are completely shielded from government. Sorry, let me go to the page. And the stability of this cash flow is not a small detail because, as we can see here, these segments and these take-or-pay contracts have remained stable even with Peronist governments such as Alberto Fernandez, which left in 2023. The cash flow that those sections generates are completely shielded from the government based on historically. So a different macroeconomic environment would affect the company, but not these segments. Maybe it would affect the funding possibilities of the company or the general country risk, but these particular segments we believe are completely secure.
Yeah, basically, we will affect it on the government side by the KD, which is the cost of debt. But in all of other things, it doesn't, because the contracts are US denominated, which mitigate, as I said, all currency risks. And these projects are, across multiple political signs, they have been stable. And what was your second question? I'm sorry.
Yeah, I would say that did you do the scenario analysis in your DCF analysis?
Oh, yeah. Yeah, this is Felipe.
Yes, we did a scenario analysis. Basically, we took the base case in our analysis, then the bear and the bull. Exactly, we took the country risk, the oil segment performance, and the refit rate.
Okay, so what is the biggest assumption or the underlying assumption of your scenario analysis? Because that is, you say the bear market, it's bear market, do you mean? And okay, the bear market normal, or you are dividing the scenario analysis based on economy. So what is your underlying assumptions when you do the scenario analysis?
Yes, so for example, for the economy, the base case scenario will be that the economy is performing as expected. Then for the bear case scenario is that the economy is not performing as well as expected. That is reflected through the country risk premium, which is double the current level. And then the bull case scenario for the economy will probably is the economy exceeding our expectation. That will drop the country risk premium to the lowest in the last 5 years, as mentioned in our third thesis. Then the oil segment performance, we took in the base case scenario, basically a very conservative approach. And then for the bear case scenario, we assume that the company won't reach to the expected production plateau, and the productivity of those blocks are not that good and also not that profitable for the overall for the company. And well, the bull case scenario in the oil segment would probably be that those expectation is exceeded.
Yeah, let me complement that. Since gas and power generation segments are pretty stable, as we explained before, maybe our bigger assumptions were on the oil segment, which is undeveloped right now. And we use Vista and YPF as comparables for these segments. Vista stood out as our most benchmark due to its greater transparency in terms of the greater data they publish of how they manage to lower lifting cost and improve margins. And the public information has demonstrated that economies of scale and lowering lifting cost leads to expanding margins, and we expect Pampa to replicate this learning curve in the future.
You guys, you use the current Brent price, I suppose, like 62, I think. Did you consider the fact that obviously there's been some recent shocks into the market in general, and prices has kind of like moved to the lower end of the 4-year low? And were you comfortable using that price to do your projections without any normalization?
Okay, sorry. We're first assuming $70 per barrel for Brent, which was the market price about a week ago. We prefer to hold the last week's price and treat it as our base scenario to ensure that consistency and avoid overreacting to the short-term volatility. So while today's Brent would place Rincon de Aranda closer to our bearish scenario, even in that case, the valuation would still support a buy recommendation when compared to Pampa's current market price, because Pampa's exposure to oil prices is limited to Rincon de Aranda, which concentrates most of the upside of our valuation beyond the core business. So if this segment were worth zero, the target price would be still close as to the market price, as I mentioned earlier. So this confirms that the oil prices impact the upside of our valuation through the optionality.
That is time.
But not the
Time.
stability.
Thank you, Universidad Argentina de la Empresa. At this time, the judges will take a few moments to collect their thoughts before the next university is brought in.
Thank you,
all.
guys.
Thank you very much.
Good afternoon. My name is Connor, and I'm here with Nathan, Simon, Andrew, and Mehek. And today we're pitching a buy recommendation on AltaGas at a target price of $43.38, representing an upside of 17.21%.
This is underpinned by our 4 key investment pillars: AltaGas's differentiated global export platform, macro tailwinds supporting outsized rate-based growth, their ability to capitalize on data center-driven natural gas demand, and the management team's industry-leading capital allocation track record.
In order to understand our investment thesis, we believe it's important to first have a strong understanding of what the company does and where it operates. AltaGas is a North American energy infrastructure company with midstream assets in Western Canada and utility assets across the PJM.
AltaGas's midstream platform connects natural gas producers to higher value global markets. After natural gas is extracted, the raw gas is separated into value-added products, which enhance producer revenues and meet growing international demand. AltaGas's edge lies in their near-exclusive access to these global markets through their marine terminals, and ultimately allows them to capture arbitrage pricing spreads on liquefied petroleum gases, or LPGs, that remain out of reach to their competitors.
It appears they operate a strategic portfolio of capital-light assets that allow them to utilize and leverage their export terminals for entering into favorable contracting with other midstream players for accessing third-party infrastructure. This drastically reduces their capital cost requirements and improves their competitive positioning in the landscape.
The second half of AltaGas's business is its natural gas utility platform. The company operates in gas distribution, which is a regulated monopoly with virtually no competitors. Because of this, revenue is determined through a bottom-up formula with allowable returns on its regulated assets, also known as rate base. With this, the company can grow through customer additions and approved rate base increases. Furthermore, the company's utilities are geographically segmented, with WGL covering the eastern US and SEMCO covering Michigan.
We have outlined our key thesis points to understand our buy recommendation for AltaGas. Our first key thesis point revolves around the global export platform business, which is well known for its differentiated netbacks. AltaGas's end market demand is driven by rapid urbanization and decarbonization in Southeast Asian markets that are looking to replace high-emission fuels with LPGs. And with excess supply of natural gas liquids in the Western Canadian Sedimentary Basin, AltaGas remains primed to meet this growing demand.
One of the largest advantages AltaGas has over its peers are the locations of its export facilities, as these have an 8-day time advantage over the Arabian coast and a 15-day time advantage over the US Gulf Coast. Through this timing advantage, along with higher international prices, AltaGas is able to achieve industry-leading netbacks.
Through optimization efforts and Reef coming online in 2026, AltaGas will be able to achieve its long-term growth export capacity of 175,000 barrels per day. And with China occupying less than 10% of their current global export mix, this remains a key growth driver for their business.
This brings us to our second key thesis point: AltaGas's ability to grow rate base through customer additions and improving aging infrastructure assets. Washington Gas and SEMCO are primed for rate base growth, with the opportunity to expand into communities that are currently reliant on propane and other alternative heating methods.
Gas utility infrastructure in the 4 states which AltaGas operates in is some of the oldest in North America, and to minimize the risk of leaks or environmental issues, government programs are incentivizing pipeline upgrades which will add to rate base and lead to meaningful cash flow.
AltaGas is already taking advantage of some of these government programs through their asset modernization initiatives. We see these initiatives as a consistent growth channel for the utilities business, with the potential for further upside with rate case extensions expected in the coming years.
For our third thesis point, and something that goes beyond the scope of our evaluation, is AltaGas's ability to benefit from data center-driven natural gas demand. To support the exponential increase in power demand from AI infrastructure development, natural gas would be the key fuel to support this demand. And among development regions, Northern Virginia has the highest concentration of data centers in North America, which benefits AltaGas's utility monopoly over the area.
AltaGas's position in Northern Virginia, which is referred to as Data Center Alley, provides significant opportunities over peers as they have already begun conversations to provide gas to data centers in the areas where they are the sole provider.
We're equally confident in AltaGas' midstream tailwinds from data centers, as Alberta has the lowest natural gas prices in North America and favorable policy supporting additional data center development. With 3 projects located adjacent to AltaGas's midstream assets, they will directly benefit from growing production in the area.
We wanted to see if AltaGas will be able to achieve our key thesis points and thus decided to evaluate their management and their ability to allocate capital. Since 2018, AltaGas has gone through it all, starting with the divestiture of their power business, followed by a complete management overhaul, to today where they've successfully integrated Washington Gas Limited and launched their global export terminals to become the natural gas powerhouse that we all know.
This management team has created value through a superior capital allocation strategy, which we have measured using the spread between ROIC and WACC. From 2019 to 2024, this economic value added spread was widely positive, highlighting the market's underappreciation for AltaGas to deliver on its growth and provide superior returns. Economic value creation has been driven by improvements to ROIC, with AltaGas's return on incremental invested capital outpacing that of midstream and utility peers. Recycling capital to high growth, value added projects has allowed the company to substantially reduce key leverage metrics, positioning them for future growth.
Beyond our thesis, we see AltaGas's ESG positioning as a strict value addition. Regulators reward AltaGas with increased rate base when they invest in green alternatives and improving the safety of their assets. Additionally, AltaGas has the benefit of being able to recover capital at an accelerated rate through its RNG and hydrogen blending investments, which earn a higher allowable ROE than their regular investments, an advantage their midstream peers do not share.
The diversity of thought and experience throughout the organization bring unique perspectives to decision-making and add to AltaGas's industry-leading ESG score.
Furthermore, AltaGas has developed symbiotic relationships with the Blueberry River and Halfway River First Nation communities, creating jobs and income for their community while accelerating AltaGas's key growth initiative.
90% of the board is comprised of independent directors responsible for overseeing management and their compensation, which is heavily tied to both operational and financial metrics.
To help illustrate our thesis, we conducted a thorough evaluation of AltaGas. For our analysis, we conducted a DCF, DDM, and comparable valuation analysis and supported this through economic value added, DuPont, Monte Carlo, and sensitivity analysis. With this, we decided to weight 100% of our valuation towards the DCF, given that there's no true comparable to AltaGas's unique business model.
We flexed all our valuation methods used and got an upside across the board. This reiterates our belief that AltaGas is undervalued and has significant tailwinds coming from asset modernization, new customer additions, and growing demand for LPGs in the international markets. Now, looking at the revenue build for the utility segment of the business, we decided to make a rate-based model since AltaGas is a regulated monopoly. We forecasted their revenues by backing out allowable earnings from the regulatory filings with all 4 states. We also forecasted a 7.5% CAGR to account for customer additions as well as asset modernization. And finally, to remain as conservative as possible, we decided to keep ROE and equity thickness flatlined.
Now, turning to the midstream revenue build, we chose to hold capacity utilization in line with historical metrics. Thus, EBITDA contribution was generated through high growth project completions such as Pipestone 2 and Reef. We also assumed that commodity pricing would return to its 2024 levels in 2029 following the market sell-off last week. We additionally assumed the sale of Mountain Valley Pipeline to occur in 2025 based on management guidance. To complement our discounted cash flow model, we conducted a dividend discount model and comparable companies analysis and also found upside across both cases. Though to reiterate, we put no weighting on these methods of valuation.
To supplement our valuation, we performed a series of financial analyses. Since 2019, AltaGas has restructured and dramatically de-risked their business, reducing leverage by more than 4 turns and optimizing capital allocation to prepare the business for future stability and growth.
Through AltaGas's effective capital allocation, they have steadily improved return on assets while maintaining stable net margins, pushing ROE to its 10% target and positioning the company for elevated capital returns throughout our forecast period.
To test our thesis against midstream and utility peers, we conducted a case study on ROIC through NOPAT margins and invested capital turnover. Over the 10-year analyzed period, AltaGas was the only company to improve on both cost leadership and differentiation, which demonstrated their unique ability to widen their competitive advantage.
Through our analysis, we identified 4 key investment risks, the first of which being the current U.S. administration's policy position. This risk has been seen across the market, though we ultimately see it as a benefit to AltaGas. While LPG prices are expected to remain weak in the near term, the differential between Asian and Edmonton pricing is expected to strengthen on the back of Asian counter tariffs. Furthermore, a stronger U.S. dollar, as well as declining Permian volumes, will support gas producers in Canada and ensure they maintain their current levels of output. We additionally see a benefit to the utility side of the business, as we view the current administration's view on gas distribution infrastructure as highly favorable and supportive of rate.
The second risk we identified is AltaGas' exposure to frac spreads, NGL prices, shipping rates, and weather seasonality. However, this is mitigated through AltaGas hedging a minimum of 80% of exports and gas deliveries across the board, with the remainder being de-risked through its active hedging program.
AltaGas's reliance on capital-intensive projects exposes them to execution risk through both cost overruns and delays. However, AltaGas has superior precedence of delivering projects on time and under budget. Now, their near-term future projects, both Pipestone 2 and Reef, are on budget and schedule, and they have locked in their return on invested capital by entering into long-term agreements for Pipestone 2 and tolling agreements for Reef.
The fourth risk we see is the potential for a credit rating downgrade, but we believe this risk is alleviated by AltaGas's sale of Mountain Valley Pipeline, which we've modeled to occur this year in line with company guidance. We modeled the sale using precedent transaction analysis at an EV to EBITDA multiple of 11 times, resulting in proceeds of $750 million, which, when used to pay down debt, results in a net debt to EBITDA multiple below the company's current target.
With this, we conclude our presentation by prescribing a buy recommendation for AltaGas at a target price of $43.38, representing an upside of 17.21%. Thank you very much for your time today, and we open the floor for questions.
Great.
Thank you. Judges, you may now turn on your video. The Q&A portion will be a minimum of 10 minutes and a maximum of 15 minutes. If there are no additional questions after the 10-minute mark, I will end the Q&A. Time will begin once the judge speaks the first word. Feel free to begin.
Great. I'll kick it off. So great presentation. Your investment thesis hinges on, AltaGas differentiated global export platform and its netback advantage, right? How sustainable is this advantage in the face of potential regulatory or geopolitical risks?
Totally. Sorry, go ahead.
Particularly affecting the, on the last part, you talked about the Asian LPG demand and trade routes. So if you can sort of touch upon those aspects, that'll be great.
Definitely. I can walk you through this. We actually see it being very, very sustainable. And so basically, the way this all works is that Mont Belvieu is the pricing hub for LPGs globally. So that's in Texas there, where almost all of the demand and output is. When you look at what's available in West Coast capacity, it's far smaller. So it actually has no implication on pricing in Asia. So this is where the arbitrage is generated. Mont Belvieu pricing drives Edmonton pricing. So as Mont Belvieu pricing moves, the cost in Edmonton changes because Edmonton pricing is just Mont Belvieu pricing minus the transportation costs between Edmonton and Mont Belvieu. So we see that Edmonton pricing go down, but Mont Belvieu pricing is what drives Asian pricing. And so when Mont Belvieu pricing goes down, Edmonton pricing goes down, which results in a spread that's still sustainable for Edmonton. And we don't see that arbitrage going away because you can't build enough West Coast capacity to actually change where the major price hub is. And this is very beneficial for tariffs because Mont Belvieu in the US is exposed to the tariff war right now with China. Tariffs are just an additional cost that's going to get added on to result in the Far East Index pricing change movement. And we saw this in 2018 when there was tariffs placed between China and the US. What actually ended up happening at the time, there was no West Coast export capacity. Mont Belvieu ended up being moved to Japan and South Korea. That's where most of the sales happened. And then Japanese and South Korean traders actually were able to capture on the tariff premium themselves and trade to China. AltaGas has the benefit of not having to go through Japan and South Korea to get to that Chinese premium. So they get to capture the entire premium for themselves while transporting at a shorter cost.
On the point of the Asian demand side of things, so the biggest driver of Asian demand is through residential cooking and heating, which makes up over 50% of the total demand. And this is very inelastic. So even if, say, China's economy goes into recession, a lot of that demand will still be there, as well as commercial heating. That demand is still quite inelastic. And even within some of the industrial use cases, some of the end products have very inelastic demand. And currently the market for Chinese, so this process is what's driving the whole industrial demand. So they're taking those LPGs and specifically propane and dehydrogenation process, creating propylene and creating a polymer to make plastics. And through this, end market goods such as packaging and consumer goods and medical devices have extremely inelastic demand. So we don't see that demand growing away. And demand is expected to increase in Asia much more than supply is expected to increase.
Got it. No, that's well thought through. Thank you. Maybe just to switch gears a little bit, you talked a little bit about the data center driven demand. How would you assess the risks of electrification or competing energy sources such as battery storage or renewable integration displacing natural gas in the medium term?
Certainly, I can speak on that one. So the way to think about the power grid. So the company operates in the PJM when you think about the power mix over there, the company's grid or the power pool was designed in support of coal assets, gas-fired assets in the 1970s, which wasn't designed around the technical requirements of renewables in today's world. And so across some power pools across the US, we've seen the significant abundance of renewables being added, contributing to a steepening duck curve, particularly in CAISO, like the California market. And if something like this were to happen in the PJM, we would see a capacity shortfall and an inability to meet the actual demand for energy. So if you think about what the duck curve means, as more renewables are added onto the grid, the intermittent capacity of these impacts the ability of the grid to actually service that and provide it to the end consumers. And so we think that a baseload power source like natural gas would be the best bridge between actually meeting those emissions reduction goals through retiring coal-fired assets, which is expected to happen all throughout the US and even more so in the PJM at the highest level. So we think natural gas is a key advantage in terms of supporting that transition. And even more so on your point for battery storage, the technical design of the PJM, again, the power pool that they operate in, wasn't designed to support the kind of technology you're seeing in battery storage today. And so if you think of the amount of development that's happened across the entire US in terms of battery storage, the PJM has been one of the slowest to actually bring on new solar and battery storage. And so we don't think that the amount of energy that's being able to be supplied by battery would be enough to offset the significant demand increase that we're seeing from not only industrialization, but also the power demand that's coming from these new data centers.
Great, thank you. I appreciate you sharing the duck curve.
Yeah, good presentation, guys. What's the dividend yield on this company?
It moves a little bit every day, obviously, with a lot of the massive price fluctuation going on right now. I think last time we looked at it, it was roughly around 3% and very much at a lower end of their payout ratio right now. So we actually do see a lot of payout ratio growth potential for the company, especially as these growth projects do come online. We think there's a lot of opportunity for that to grow and return capital to shareholders.
So there is a stable dividend payout from this company, confirm. Okay. So can you explain to me why you didn't choose to incorporate the dividend, just the dividend discount model in your valuation, and you pick the DCF at 100%?
Yeah, so for the reason why we didn't include the DDM and just went straight for the DCF, this was mainly due to just the business being so complex and having all these different parts. We wanted to fully capture all the different growth aspects for the business. So we wanted to do the DCF so we could have the actual midstream breakdown and the utilities breakdown, whereas the DDM just looks at the company as a whole. So we really wanted to focus all our valuation on a method that really incorporates each specific segment separately.
But did you get to a point where you could see if there were differentials, like static differentials, or you just completely ignored the dividend model?
Throughout like our entire valuation, like we updated it throughout the whole process since January, and pretty much every time we either changed some of the assumptions as market sentiment changed, we were seeing that on like relatively the price increase, the valuation from the DDM and the valuation from the DCF were relatively in line.
Okay, so you were running it parallel, but you just didn't incorporate it in your. Okay. On your DCF, since you had 100% reliance on this as a valuation model, what was the greatest assumption that you made in your DCF, and how did you get comfort around that assumption in the model?
So the biggest assumption on the utility side of our DCF would be at what percentage would the rate-based growth happen. So the company guidance is 8%, which is in line with other peers in their historical performance as well. 7% comes from asset modernization and 1% comes from new customer addition. We decided to use 7.5% as we wanted to be as conservative as possible. 7% attributing to asset modernization, as 1.7 billion of it is already locked in for our forecast period. And we attributed 0.5% to customer additions that we believe, as they have been adding 1% every single year. And this is 40% higher than the national average, but we still discounted it a little bit. We see more upside here. We see they will be able to get between 8 and 10%, but we wanted to be as conservative as possible in our valuation.
Okay, thank you. And again, because you said this company, there's little competition here, right? So there's no risk of threats to entry and stuff like that?
Absolutely. So if you think about the utility side of the business, it's a regulated monopoly. So across Virginia, Maryland, DC, and Michigan, where they operate, there is no risk of a new competitor coming and taking their place, since they're entrenched with the regulator, giving them being the sole provider of natural gas into the region that they serve. And so we see no risk of this being taken over. And we also see this as a huge advantage, given that they're actually positioned over Data Center Alley, which is the highest concentration area of data centers in North America, and no other player can come in and take that from them. And so we think that's a significant growth opportunity given the landscape with investment in data centers right now.
Just last question, I'll pass on. So on the data centers, any read through what is happening just now with the slowdown that's coming through, Microsoft slowing, in terms of expenditure? Do you think this is going to be a thing going into the future, to the magnitude that you think it's going to still support, demand in terms of maybe energy uses?
Totally. So we definitely are very aware of the data center slowdown. I think it's very key to highlight where the data center slowdown is occurring. These are in jurisdictions outside of the PJM. The PJM is the premier investment space for data centers. And so the PJM has been so backlogged because everyone wants their data centers built there, given the investment incentives for them. So now that it's been so backlogged, there have been a lot of people starting to look at other jurisdictions, Texas and other regions where they can invest, where these are slightly less optimal to invest in these regions. And so that's where a lot of the cuts are happening, is in these other regions. Also, in saying that, we still feel very confident in looking at this as a definite tailwind for the company, because the PJM is so backlogged, and specifically Data Center Alley is so backlogged, and it's the slowest place for approvals for transmissions, as you can see on the right-hand side there. And that these data centers are looking, they want to get their investment online. They're already looking to build behind the grid power production because they need to get it online, because they can't get that transmission acceptance, which really results in AltaGas being the only one that can provide them the gas to build that behind the grid power generation.
Oh, thank you. Good answer. Thanks. I'll pass it on.
Okay, so thank you for the presentation. So I have one question about, so just to follow in the last judge, talking about the competitors. I understand the AltaGas is a gas company. So for the perspective of the natural gas provider, it may be the monopoly, but there are other resources. Like electricity company, especially recently, the solar energy, that could be the competitors as well. Have you considered these competitors?
Yeah, I can speak to that again. So I think for the competitive landscape in terms of providing natural gas to power these data centers, which would be a great growth opportunity for them, I think it really comes down to the reliability measure. So if you think of why natural gas is being chosen in the first place, it's because it's significantly the most reliable and energy efficient source that you can get to power a data center. And this form of baseload power is really advantageous, because when you put it in comparison to an intermittent power source, it comes back to the duck curve. If you think of what solar can do or what wind can do, they're intermittent power sources. And given that data centers have a really high reliability time, and they can only be off by 5 minutes per year, otherwise they're operating the entire year, we think that demand that has to be met by something that's a baseload power source, and solar and wind simply can't support it. And so we think that natural gas is the most viable, and that new sources of energy like nuclear wouldn't be able to be more competitive in the near term, given that SMRs are still in an earlier stage of development. And if you think of the levelized cost of energy in comparison to natural gas in the current market, it's currently not cost competitive, nor is it developed enough to the point that it would be able to come in and take share from AltaGas when they're able to get to market faster than anyone else and provide this at a low cost and get these data centers up and running. So for these reasons, we think it's very advantageous.
Okay, thank you. I understand that from qualitative perspective, that you did a good job of incorporate these factors in your DCF. Do you just totally exclude these factors, like the possibility that that is kind of the possibility, even though that is, you think that based on your analysis, you think that it's very minimum, that the other resources may be comparable, but in your DCF analysis, did you consider at all, or do you do the sensitivity analysis, scenario analysis about this extreme situation?
Yeah, so in a more extreme situation, we think that even given that it's a regulated monopoly, that energy has to flow through AltaGas. So when we were modeling this out, we didn't fully consider we didn't factor into our valuation the absolute growth potential that would come out of data centers. And so we felt this was more of an add-on into our valuation. And when we're thinking about the rate-based model that we constructed, given that they are a regulated monopoly, we want to remain conservative with this. So the way we approach this for forecasting out their revenue and growth was through adding CapEx, which would grow their rate base, and then we deducted out depreciation. And so since they've aggressively been expanding their ARPs, they have this growth locked in until 2028, and we're confident that they'll be able to extend that beyond which. And so given the fact that this is fully locked in, we felt that the growth potential that we assumed was very conservative and that it wouldn't be able to be entrenched by another source of energy like nuclear in the near term.
And then I could just touch on the other.
Thank you, University of Alberta. At this time, the judges will take a few moments before the next university is brought in.
Thank you very
Thank
much.
you,
guys.
Thank you all.
Thank you, guys.
Thank you very much.
Hello, are you able to see my presentation okay?
Yes.
Thank you.
All right. We ask that you remain muted unless you are speaking. Time will begin as soon as a member of your team speaks the first word. You will receive a 1-minute warning and time will end precisely at 10 minutes. Feel free to begin whenever you're ready.
Thank you so much for joining us today. We're here representing the University of Oklahoma's Price College of Business. My name is Christian Eatman, and these are my teammates Nicole Zerwinski and Tucker Dunn. And we're going to be telling you as to why you should gas up your gains by investing in ONEOK. Getting a little bit into the segue of our information, our closing date for our buy recommendation came from April 7th, 2025, 3 days ago. A little bit into our valuation mix, we had 5 different valuation models, which ultimately using that weight led us to a target price of $91.84. And that upside of 13.50%. And I'll now give it over to Tucker to talk about our investment themes.
Thank you, Christian. So the first theme we'll be discussing is capital allocation. The main point here is mergers and acquisitions. That is ONEOK's main growth method. They've recently acquired, for example, EnLink and Magellan. Those have both grown their pipeline networks. They also have a commitment to a growing dividend, so they maintain about a 75 to 85% payout ratio. We think that's high enough to be attractive for equity investors, but conservative enough to save cash flow for these mergers and acquisitions, as well as CapEx. On the next point, that'll be ONEOK's business model. We think that this lends ONEOK a lot of resiliency through their long-term contracts and volume-based fees. This insulates ONEOK from the effects of short-term price fluctuations in the commodities they deal in. Lastly, I want to talk about increased demand. We see a long-term increase in demand from the manufacturing, infrastructure, and AI industries that are going to grow in the US. We see ONEOK as a major contributor to those demands. Next, moving into the business description. On the left here, you'll see ONEOK's pipeline network throughout the United States, including recent acquisitions. That is their main business model. They use their pipelines to move natural gas, NGLs, and crude oil. You'll also see here on the bottom is the gathering and processing segment. That's about 1/6 of ONEOK's business. That is kind of the downstream side of the business. And then on the right, you'll see 2 charts pre and post acquisition of EnLink and Medallion. I also do want to highlight this gathering and processing segment you see in green grew from about 1/6 to 1/4 of the business. And that's primarily through their internal capital expenditures. They developed what's called a fractionator that changes natural gas into its components of ethane, methane, butane, etc. And that adds another portion to their business. I'll now turn it over to Nicole with the competitive analysis.
Thank you, Tucker. Their strong competitive positioning is based on four main factors. The first being their steady revenue stream. It's due to the fee-based model system that Tucker discussed, and this promotes their predictable and stable cash flows. As well, they've benefited from placing their pipelines in high-demand regions to ensure their cost efficiency. Moving on, we have the long-term growth potential. This is due to the steady demand for natural gas and NGLs, as well as the ongoing technological advancements made by ONEOK. Relating to the Porter's five forces, there's stability in the industry as the threat to new entrants is low due to the high barriers of entry. Moving on, the industry rivalry is moderate as there's already market dominance relating to the key players through the pipeline infrastructures they've established, leading to a great competitive positioning for ONEOK. Overall, our analyst team feels that their competitive environment is stable without hostile competition between the key leaders. Moving on, we'll look at the financials. On the left, these metrics show where ONEOK is outperforming its competitors in their ability to efficiently use capital and assets to generate consistent profits. These include their return on equity, return on invested capital, and return on assets. ONEOK has a strong return on equity that's driven by their total asset turnover rate. Looking at the graph on the right, ONEOK is represented by the green line with the diamonds, and as you can see in 2020 and 2023, their past acquisitions show a pattern of post-acquisition efficiency gains and their ability to quickly integrate. Many competitors show stagnation in their asset growth, while ONEOK's strong M&A strategy supports sustained revenue growth and represents their capital expenditures and operational efficiency. Before we move on, I'd like to point out on the bottom left, we have our weighted average cost of capital. ONEOK is sitting at 7.53, which is relatively similar to the industry average, but as you can see by the return on equity at the top, ONEOK is extremely outperforming its competitors. I'll now hand things back over to Christian to break down our valuation.
Awesome. Thank you so much, Nicole. So over on the right-hand side, you can see a pie chart that references that valuation mix that I had mentioned at the very start of the presentation. This is just included to give you a visual reminder as to our two main methods of valuation, that being the free cash flow to the firm's equity holders and to the firm itself. Our revenue assumptions were based on business segmentation that Tucker had previously mentioned across those four business segments, starting with a range of 11.06%, dropping to 7.59% in that year 1 to year 3. Following in year 4, we dropped by 3% and a 2% drop off in year 5. This was incorporated as a level of short-term conservatism in our model, as we felt that ONEOK is in a high level of growth and will ultimately stagnate shortly over the short term. We also see that our perpetual growth rate, which originally was at 2.75%, but dropped 50 basis points after the announcement of the tariffs in order to incorporate the long-term aspect that these tariffs will have on the overall underlying price of the commodity and therefore its overall demand. From here, we're able to see an overall breakdown of our FCFE and FCFF model. Our cost of equity was determined using the capital asset pricing model and was utilized as the discount rate for our FCFE, which ultimately led to a price per share of $103.59. On the right-hand side, we can determine that the weighted average cost of capital as measured in the metrics such as beta, cost of debt, tax rate, and debt to equity ratio, as noted on the right-hand side, was utilized as the discount rate to determine the overall enterprise value of the firm. From there, we subtracted our net debt of equity to determine, the market value of equity, which led us to a price per share of $96.74. Moving forward, we utilized a dividend discount model, which was important to incorporate due to the high payout ratio that Tucker had previously mentioned. Utilizing the cost of equity once again as our discount rate led to a price per share of $61.56. Moving forward, our residual income model ultimately used once again that cost of equity with our perpetual growth rate to deliver a $61.19 price per share. It should be noted that these two models are inherently more conservative and do not take into account the impacts that the $2 billion share repurchase authorization, as well as the overall value of intangibles caused by the acquisitions within our residual income and dividend discount models. Lastly, we have our multiples model, which compared the industry median EV to EBITDA ratio to ONEOK's trailing 12-month EBITDA. This determined our enterprise value, once again subtracting the market value of equity or market value of debt to determine the market value of equity, leading to a price per share of $101.93. That concludes our valuation section, and I'll now give it back over to Tucker to talk about ESG.
Thank you, Christian. So just starting out here with environmental factors, we do want to applaud ONEOK. It's got a goal of reducing emissions by 2.2 million metric tons by 2030, and it's achieved 77% of that goal already. And this isn't accomplished by purchasing renewable energy certificates like some of its competitors, but actually by decreasing its own emissions and those of its suppliers. They've also invested in carbon capture programs, which we do see decreasing the effect of emissions in the future. Next, on social, we want to highlight that ONEOK is committed to a zero incident culture. They've achieved this by requiring about 120,000 hours of training for their employees between 2023 and 2024. ONEOK was also voted as one of America's greatest workplaces in 2024 by Newsweek. Lastly, for governance, 9 out of 10 of ONEOK's board members are independent, and that does include board chair Julia Edwards. We think this is a pretty unique factor for the company. Also, they release a monthly investor report, which goes above and beyond what you see other public companies or even other midstream companies doing to promote transparency for their investors. On the right, you'll see ES and G scores. ONEOK is above the median for environmental and then is leading the industry for social, governance, and sustainability. With that said, I'll hand it off to Nicole for risks and a summary.
Thank you, Tucker. So with investment risk, we'll start with liquidity and credit risks. There's a moderate probability and a high impact. ONEOK is reliant on debt for expansion, but they have solid debt management to position
1 minute remaining.
to mitigate their credit risks and protect their growth. They maintained a controlled debt to EBITDA ratio of 3.5 times. Moving on to environmental risks, there is a high probability and a low impact in the short term. Environmental scrutiny is rising, but the demand for energy is consistent and inelastic. Moving on, we have the geopolitical and security risks with a moderate probability and a moderate impact. ONEOK is diversified and they invest in cutting-edge security to protect their operations. Do not let these risks deter you because overall, our discussion supports ONEOK benefiting from a macroeconomic demand for energy, the resistance to commodity pricing, and as well, they have a high payout ratio of dividends at 80% and $2 billion of share repurchase. This supports our buy recommendation at 13.5%. Now it's time for you to gas up your gains. Thank you.
Thank you. Judges, you may now turn on your video. The Q&A portion will be a minimum of 10 minutes and a maximum of 15 minutes. If there are no additional questions from the judges after the 10-minute mark, I will end the Q&A. Time will begin once a judge speaks the first word. Feel free to begin.
Great. Thank you. Lovely presentation. I like how you ended it with gassing up ours. So your valuation incorporates 5 different methodologies with pairing weightings, right? Could you explain how you determine the specific allocations across these models and how sensitive your target price is to these weights?
Yeah, I'll go ahead and take that one. Thank you for the question. So you'll see that Christian just pulled up our sensitivity analysis. This shows 6 different valuation mixes and different weights that we could have used that you could use for analysis as well. And you'll see that the only valuation mix which gives a negative upside potential would be that full bear analysis, which uses really only the residual income and dividend discount models. We see both of those as more conservative and deserving of less weight, generally speaking, because they do leave out factors like share repurchase authorization and the intangible assets that ONEOK has accumulated through its mergers and acquisitions. There's a lot of goodwill on the balance sheet that wouldn't be reflected in those analyses. So that is why we decided to put more weight on the free cash flow to firm and equity holders methodologies. Yeah, I think that's all I have if anyone else wants to give a comment.
Great. Staying on the capital side, you talked about ONEOK's high dividend payouts and the significant capital needs for expansion and also acquisitions. How did you assess the sustainability of both the dividends and future growth initiatives under the various economic scenarios?
Yeah, so I'll start with that. After speaking to the firm, we've seen that they want to hold their dividend payout ratio between 75 to 85%, and not having too much growth throughout the years because they do want to still, be able to complete the mergers and acquisitions as well. I did mention their debt to EBITDA ratio at 3.5 times, which they're able to also hold steady and as well help kind of mitigate against that credit risk of, the risk of their credit rating going down and not being able to access debt for expansion. But historically, they have been able to keep up with that and keep relying on debt. If Christian, you have anything to add?
Yeah, thank you so much, Nicole. Just to kind of add a little bit to what she was saying, I really wanted to draw some attention specifically to our financial analysis section and looking at this total asset turnover curve. This curve is demonstrating the overall operational turnover of the increase in assets followed by the overall turnover or result in revenue increases by those assets. What we can see is that overall, historically, due to ONEOK playing the role of almost a capital hero, relieving capitally constrained firms that are no longer able to reach their own growth potentials due to their limited financing options can instead operate as a sustainable acquirer of small firms. If we continue forward, we're able to see the overall expansion plans for what the firm utilizes, and we can see that overall, this being the joint venture program as well as a pipeline acquisition, the majority of their overall business expansion comes from these expansion opportunities by relieving these capitally constrained firms or capitally constrained projects. And so when we're thinking about its sustainability, tying back to your question, we argue that it's very sustainable, and ONEOK is very much posited to pay attention to the high level of risk that the overall credit risk has for it. If its credit risk were to drop, then it would ultimately result in a drying up of its long-term ability to finance these projects. But because it pays attention to this on a consistent basis and it mines so, it is not a cause of concern for our valuation. Thank you.
Great, thank you. I do have another question, but I'll pass it on to the other judges, and if there's time, I'll pick it up again.
Thank you, guys. Good presentation. So just on that, I think I had a few questions again on that. Remind me again, is the debt equity 70%?
Yes, that's correct. So based on our debt to equity ratio that we had listed within the finance or our FCFF model, the debt to equity ratio sits at about 70.56%.
Okay, so what are you seeing happening here? These guys, they are paying out 80% on dividends. They are repurchasing their own shares, which means they are trying not to retain some of the equity, right? But they are keeping on debt so high like that. What's the logic here, and what are you seeing in terms of modeling your prices? Because we are seeing a lot of movements on yields, right? So rising yields can have a direct impact, definitely on the debt, but they are also using, excess cash to pay dividends and to repurchase shares. What is really going on here, and how did you capture that in your valuation?
Yeah, so just a first comment on this question. I appreciate it. We do think that ONEOK, because it has that volume-based and fee-based structure for revenues, we think it can support this high level of debt. We do think that it's obviously reliant on credit markets to be able to support acquisitions. It is going to be sensitive to yields changing, like you mentioned. But we do think ONEOK is able to be more stable than other firms in this industry might, because ONEOK is not so reliant on pricing fluctuations. So it has a more stable, more predictable revenue that we can foresee is easily able to pay their debts as well as maintain the dividend. We spoke with management. They're very confident. They view this dividend as a promise. They view it as when they have the opportunity, after M&A is completed, after the debt is paid, after the dividends are paid, then they'll look at share buybacks. We mentioned that that's a $2 billion authorization. We haven't seen too much of that used, but management says that they're looking to use that once they complete some more of these projects for M&A and CapEx.
So I see you used 5.21. Was that the cost of debt that you used?
Yes, that would be correct. So for our FCFE model, the cost of debt was that 5.21%, which came from the weighted average yield to maturity of the bonds issuances by the firm.
Okay, okay, okay. Yeah, that was the next question, how you came about that number. And then the last thing would be maybe one of my questions is on the industrial averages. So there's a slide that you had there which was showing us, yeah, right there. So given that this space is very limited and I think you also mentioned that there is, barriers to entry and stuff. How comfortable were you to bring this analysis in terms of this company and the industry in terms of, saying it's doing okay, obviously, on a relative basis, but then the industry in itself is not a true reflection of the averages in this case, I suppose.
Yeah, I can go ahead and take that question to start. So one area that I kind of wanted to bring attention into our relative valuation that we didn't incorporate within our slides is this comparison of the PE to earnings growth ratio. This is taken from a website called Simply Wall Street and is basically a visual aid to be able to demonstrate the comparison of the peer average PE ratio, or on average, the price per earnings, as well as the overall growth section. We can see that the firms following within this green area are seen to have relatively high or good PEG ratios, those PEG ratios. And that's one area that we're kind of confirming. The firm is not in comparison to the rest of the industry, the firm is not overly leveraged. We've seen that a lot of the firms within the midstream industry use leverage as a means of financing their overall capital expansion or their expansion within their business. And that once again comes down to the consistency in their revenue projections. We've found that the firm overall had lower cash flows or didn't want to hold on to cash, tying back to your previous question as to how we incorporated it within our model. The overall cash levels were seen as being relatively low because the management does not want to hold cash. It has very high consistency and predictability within its revenues, and so it wants to either pay forward those in the forms of dividends, such as through its high payout ratio, or maintaining that cash for future expansions and opportunities, so that way it's not entirely reliant on debt. However, when looking at industry averages and, overall the rest of the industry, it's very commonplace for not only them to be leveraged in that way, but is also, as we can see on these graphics, the overall PE ratio of the firm in comparison to its earnings growth is relatively sound. Thank you.
Yeah, thank you. Thank you. Good answer. I'll pass on to the next judge.
Thank you for the presentation. I enjoyed very much. So I have, I think, two questions if I have time. So one is that you briefly talked about ESG. So how do you incorporate ESG factors into your valuation model?
Yeah, so I appreciate the question. In terms of directly, we mainly focused on these when we were looking at our revenue projections. We did look back mainly based on 5-year averages for revenue. But we did look at incorporating these factors, ESG, primarily governance. If we saw issues with governance in a firm like this, we would see that as a big red flag, especially a relatively small firm in the industry. We would see issues if there were a lot of governance problems with evaluation. We would have had a higher cost of capital. Additionally, environmental. If there were big environmental issues, we would have had to have a higher cost of capital to reflect a higher risk from things like regulation. If the firm wasn't doing so much to cut emissions, we would think that would make it a target for regulatory action in the future, especially if you had an administration in the future that wasn't so friendly to oil and gas firms. So while we didn't feel the need to factor these things in directly to our valuation, we did consider it and decide that these weren't posing a major risk because ONEOK has such strong ESG.
Okay, thank you. And my last question is, so this is a natural gas company. So it is like, I believe that infrastructure is their major cost. So they have higher fixed assets. So that what depreciation expenses should be a major component of the cash flow. Can you talk a little bit more about that?
Yeah, so what we found overall within this industry, as you previously mentioned, these pipelines are comprised mostly of those physical assets. And what we found is that the overall tax benefit, or how these companies utilize this depreciation for a tax benefit, is primarily through the model of double declining depreciation. When they're undergoing these large amounts of assets, they want to utilize this depreciation expense as a means of lowering their overall income tax expense. And the best timing for them to do that is going to be lining it up when they're actually undergoing the large expense of their acquisition. And so they typically within the industry, especially ONEOK itself, uses this double declining depreciation method in order to offset the costs that it's going to suffer from the large scale acquisitions, therefore kind of taking into account and stabilizing its cash flows over long term. Thank you.
Okay, thank you for the answer. So to follow up that question, so is this company's infrastructure is relatively new, or you are saying it's expected to have to renew their infrastructure, their equipment?
So I'll start on that. Thank you for the follow-up. So they've already established their pipeline infrastructure, and with these further acquisitions of the smaller companies, they're able to take those smaller companies' already established infrastructures as well and just sort of combine them without having to lead to a lot of new builds of the pipelines itself. And I think Christian can add on to that as well.
Yeah, just to kind of add on to that, when we're thinking about the history of the NGL business as a whole, it's relatively new. It's not a very long-term business that's existed for multiple decades. And so the result of that is that a lot of this infrastructure has been created within the past 10 to 15 years. When we're thinking about the overall depreciable lifespan of these assets, ONEOK tends to depreciate the assets on a 30 to 45 year lifespan. And so we find that while there will be, maintenance exposure and all of these other, contingencies, it's not something that's going to impact the short-term stock. And so that's kind of how we factored it in. Using the graphic that I've demonstrated online, or sorry, on the screen right now, we can see that there is an overall, maintain a good strong pace of new projects, which once again are refining and creating more logistical systems or going through joint ventures. These joint ventures, for example, are creating new overall pipelines, whereas the acquisitions and the mergers that have happened prior are more so acquiring and taking into account already existing pipelines. So there's a fine mix and balance, but overall, most pipelines don't have a lifespan that's longer than 15 years. Thank you.
Thank you. I have no more questions.
I could go. I have one last question. You emphasized on technological and infrastructure advantages as competitive strengths, right? How do you factor in cybersecurity risks and potential for regulatory changes around emissions and carbon capture in your investment thesis?
So I'll start just on the regulatory side of that answer, or of that question, sorry. We see in the short term an administration that is very friendly towards natural gas and oil.
Time. Thank you, University of Oklahoma. This time the judges will take a few moments before the next university is brought in.
Thank you so much for your time today, judges.
Thank you.
Thank you very much.
Thank you. Good job.
Thank you, guys.
Welcome, University of Waterloo. Please launch your presentation and make sure everything is working properly.
We issue a buy recommendation on Bombardier Recreational Products, or BRP Inc., with a 12-month target price of $62 and an 18% upside. Our recommendation is supported with primary research and the following 3 thesis points. 1, BRP is best positioned to navigate macroeconomic headwinds. 2, BRP has built a structural moat through accretive investing. And 3, BRP's innovation strategy will drive future returns. To show how BRP incorporates ESG practices into their daily operations, we've placed ESG stickers throughout our presentation, as shown by this legend.
BRP is a leader in the powersports industry, a category of high-performance motor vehicles. The majority of their revenue comes from their year-round vehicles, with 30% of revenue coming from seasonal products. The remaining 15% of revenue comes from their accessory segment, which includes parts and add-ons for their vehicles. Now, BRP's marine segment is currently undergoing a sale process, which we see as a significant catalyst for the company going forward. And BRP owns its value chain, allowing the company to quickly scale production while maintaining their high-quality standards. In speaking to management at BRP's largest competitor, Polaris, we learned that BRP ships materials and parts directly to manufacturing sites, avoiding the additional tariff exposure that Polaris faces. Once BRP assembles their vehicles, they are then sold to both a network of distributors and individual dealerships.
Now to look at the competitive landscape. BRP's closest peers in the powersports industry are Yamaha and Polaris. However, Yamaha does not compete in the three-wheel vehicle segment and the snowmobile segments. On the other hand, Polaris is a larger competitor, competing in all the same product categories as BRP. Now, to understand the landscape of powersports consumers, we created 2 surveys on online forum pages. In the first one, we learned from around 20 respondents that over 85% of powersports buyers are enthusiasts who buy a new product every 1 to 10 years. In the second survey, we received over 50 responses, where we learned the average buyer cares most about quality, price, and performance, and BRP's products are best suited to meet these needs. Since 2018, BRP has grown its market share by 6%. In the same time period, Polaris has only grown its market share by 2%, and other peers have lost market share.
When we look at the company's stock chart, we notice 2 distinct periods. The first is when BRP outperformed peers, and the market gave them credit for their market share gains. The second is when the industry started to decline. This is because high costs of debt and high inflation led to a declining number of powersports purchases, and tariffs now present a new concern. When we start with the macroeconomy, we notice that conditions have deteriorated after improving earlier in the year. The main cause of the decline in consumer spending outlook has been tariffs. Additionally, household debt to income was improving, though macro conditions may impact this as well. Overall, we noticed that the setup for powersports buyers was improving, but tariffs now present a new challenge. BRP is at risk of tariffs due to their Canadian and Mexican production. BRP has not been hit with tariffs yet, as all of their products are USMCA compliant. However, the stock is re-rated significantly with each tariff announcement.
Now, we believe the current market currently sees the consumer is remaining pressured. Their challenges on BRP's peers are structural to the industry, and BRP's research and development spending is risky. However, we carry the view the consumer is well positioned to handle tariffs and other macroeconomic impacts. BRP has built a structural moat, insulating it from peer challenges, and BRP's R&D is thoughtful and meticulous. Implementing this differentiated view yields an 18% upside.
Our first thesis is that BRP is uniquely positioned to navigate macro risks despite the market's pessimism. So based on historical growth and expert input, we believe the industry has largely stabilized. Though current macro impacts like tariffs remain a key concern, we also see it as a chance for the market to recognize BRP's relative strength, and our conviction is backed by 3 advantages: strong pricing power, a premium mix that supports margins and demand, and a larger share of desirable inventory that gives BRP a floor plan edge. Now, BRP has strategically positioned itself as a premium powersports brand, consistently driving demand for higher-end models, even during slowdowns as seen on the left. And this especially paid off in 2023 amid demand pressure. While peers like Polaris lean on promotions, BRP was able to leverage its pricing power to actually grow margins, which underscores the strength of its premium strategy. Now, selling higher margin products requires well-capitalized and motivated dealers, and BRP stands out. Our web scraper analysis of 16,000 products, as well as dealer conversations, confirmed that BRP leads in new in-demand inventory and is among the most profitable lines to carry. So with fresher inventory and stronger dealer economics, BRP is well positioned to gain share and strengthen its leadership. As for the worst case scenario, our analysis estimates that tariffs will result in a $230 million EBITDA hit for BRP, which is in line with the streets. Seeing as how this risk appears to be fully priced in, we believe that now presents an attractive opportunity to buy BRP, a high-quality business with structural advantages that will support their recovery.
Our next thesis is on BRP structural moat as a result of their accretive investing, yielding class-leading returns on invested capital of 20% while supporting future growth. In the snowmobile segment, idiosyncratic headwinds forcing competitors out of the market paved the way for BRP to lean on their manufacturing moat to immediately capture significant market share. We believe this will add $100 million in incremental revenue for BRP in 2025. Now, in the rapidly growing side-by-side vehicle market, we believe BRP's recent manufacturing investments, coupled with their superior vehicles, will underpin further growth. BRP management notes that the new manufacturing facilities purely dedicated to SSVs unlock the capacity to capture an additional 10% market share, supporting their continued rise in the segment. And BRP uses these structural advantages to produce the highest quality vehicles, a vital factor for attracting and retaining customers. Nearshoring efforts support the integration of proprietary durability features at significantly lower costs. And this is while BRP continues to source from high-quality suppliers, whereas Polaris has shifted towards a greater reliance on low-cost countries for parts. These quality differences, echoed by the experts and dealers we spoke to, are clearly reflected in BRP's significantly lower recall rate than of Polaris.
Our third thesis is that BRP's innovation is driving market share gains. BRP has succeeded in their investment in innovation, as best shown by their superior returns on R&D. This is because BRP produces products that are appealing to customers, and we believe that this trend is structural, which is best shown in the example of the Sea-Doo Spark. When we spoke to the former design executive at BRP, he told us that BRP's management challenged them to create the Sea-Doo Spark. It is 50% cheaper than Pierce's products while having the same level of quality, bringing new buyers into the space. This is the sole driver for industry growth from 2014 to 2016 and led to market share gains. We believe that this trend will continue, as best shown by BRP's 2025 model year. As one analyst said, this model year is the most productive to date, with 5 new products compared to Polaris, who released 0 new products. They just refreshed old models. From a survey of over 50 respondents, we learned that the increased power, the improved product, all at an affordable price, is bringing customers to BRP and away from Polaris.
Now moving on to environmental, social, and governance. We developed a proprietary scorecard to assess BRP's ESG strategy and found that they are penalized by external platforms due to their limited disclosures. However, when evaluating strategies separate from disclosures, we found that BRP has a robust ESG approach and should score in line with peers. In environment, BRP is a leader in climate strategy. It has the lowest emissions in its pure play peer group with consistent declines over time, and nearly all facilities use 100% of renewable energy. For social, BRP outperforms peers with strong product responsibility, above average workforce diversity, and a strong commitment to workforce safety. For governance, BRP has strong management and shareholder alignment. Compensation metrics are directly tied to operational improvements, as a net working capital metric directly leads to inventory efficiencies, and the quality metric leads to fewer product recalls. While the dual-class share structure does present some risk, we believe that it is mitigated through alignment with the company's 3 major shareholders. Overall, we have confidence in management's ability to successfully execute their ESG strategy, and no ESG discount was applied to our valuation, as they already suffer from a liquidity discount.
Now looking at valuation risk and mitigants. Currently, BRP trades at a 9% discount to its peer set. This discount is driven by 2 main factors. Number 1, the company's liquidity concerns around its dual-class share structure, and number 2, the impact that temporary destocking had on its market share. To intrinsically value BRP, we use a top-down approach, multiplying industry unit sales by BRP's market share. Our base case assumptions include flat industry growth during our forecast period, a 1% year-on-year growth in market share, a 3% CAGR in pricing, and a 1% CAGR in revenue coming in from tariff price pass-throughs. And we also see a short-term benefit from the PANA segment driven by elongated replacement cycle. This results in a 5% CAGR overall. Now, over the same period, we expect BRP's operating margins to improve, although they will take longer to return to pre-COVID levels. This growth will be driven by lower promotional spending as increased R&D investments begin to drive more demand, and higher consumer demand is going to support stronger pricing power. The tariffs will have a negative impact to the tune of 100 basis points on BRP's margins. Now, using a WACC of 10.6%, we are derived from adjusting their cost of capital for foreign exposure on our DCF and combining with the relative valuation, we get a target price of $62 with an 18% upside.
So one key risk we like to address is the health of BRP's balance sheet, as their leverage ratio and DIO are both elevated relative to pre-COVID levels. That said, we're less concerned given BRP maintains the covenant-like structure and has seen a 20% decline in inventory right now. With that, we'd like to reiterate our buy recommendation on BRP. Thank you for your time, and we open the floor to any questions.
Thank you. Judges, you may now turn on your video. The Q&A portion will be a minimum of 10 minutes and a maximum of 15 minutes. If there are no additional questions from the judges after the 10-minute mark, I will end the Q&A. Time will begin once a judge speaks the first word. Feel free to begin.
Thank you. I can kick off the Q&A. Again, great presentation. Your thesis, rests on BRP's ability to pass through tariff positioning, right? Can you elaborate on how sustainable this pricing power is if the macroeconomic headwinds worsen or competitors lower prices to maintain volumes?
Yes, so we believe BRP is exceptionally resilient to any competitors' lowering prices as well as inflation. BRP targets a very high earning income individual as their target customer, north of $140,000 of annual income. And we also believe that given the current macroeconomic situation, with anticipated rate cuts nearing 100 basis points by the end of the year, in the dealer conversations we had, we learned that there's both a very strong underlying demand for power sports, as well as over 80% of these purchases being financed through debt, which we believe is a major catalyst as we see cost of debt expected to decrease going forward.
Got it. You talked about innovation, and you compared Bombardier with the other competitors. Could you clarify how you differentiated between innovation that drives consumer preference versus innovation that simply increases costs without a clear return on investment?
Absolutely. If we look at the example of the Sea-Doo Switch, which is a more recent example, we actually see an example which we were able to speak with of a former executive at BRP who's a design executive. We also spoke with 2 industry consultants with over 30 years of experience. And what they told us is BRP by far has the best balance of innovation and returns. When you look at the Japanese competitors such as Yamaha and Kawasaki, they do not do a lot of innovation. They just make a great product and they keep that product the same. While this is good for certain buyers, it's not exciting to the enthusiast buyers like BRP and Polaris. However, when we look at Polaris, we notice that they have elevated innovation, but they also have elevated issues with things like recalls, which when we spoke to this design executive, he told us it's because they try to innovate and actually rush the product out. And so the example of the Sea-Doo Switch is a great example of BRP spending on innovation and becoming the 3rd highest sold product within only 2 years in a very competitive space. And so that's how we differentiate between a product actually yielding returns and just being spending for the sake of spending.
Got it. No, great answer. Thank you. I'll pass it. I have another question, but I'll pass it on to the other judges and I'll pick it up if there's time left.
Yeah, no, thank you guys. Good presentation. But I reckon you didn't spend too much time on your valuation. I think you left a little time for the valuation. So let's go back to the valuation and talk a little bit. I know you brought in DCF and relative valuation as a method. So talk us through again what exactly you did there. How did you weigh these two together, and what was your thinking process in some of the significant inputs?
Yeah, for sure. So for our valuation, what we did was we looked at 30% of it coming from a relative valuation, and then we looked at the rest 70% coming from our DCF. So the reason we only use 30% for a relative valuation is we noticed that BRP's peer set includes a lot of the Japanese conglomerates, which tend to not trade in line with the BRP and Polaris, but also suffer from conglomerate discounts. So we felt that applying a higher weight to the relative valuation was not appropriate in this scenario. And this is why we weighted a higher weightage to our intrinsic valuation or our DCF. For our DCF, we derived our terminal growth rate. We derived a terminal growth rate of 1.5%, which we got by looking at the long-term rate of units growth in the industry and took a discount to that. And then for our exit multiple, we looked at a discount of their long-term trading multiples historically, and we got a 7.5 discount there. So effectively, we combined our relative valuation at 30%, and then our other 2 valuation methods were DCF exit multiple, DCF terminal growth rate at 70%.
Okay. What out of these inputs that you estimated and had to come up with, assumptions, which one do you feel like is more susceptible to, causing a challenge to the valuation, and how did you get comfort in that number?
Yeah, for sure. So we actually looked at the biggest impact actually that could detract from evaluation here is the rebates. So just for context, rebates are what BRP provides to dealers in the times when dealers have to get inventory through and they have to pass discounts to their customers. And here we notice that BRP, in a scenario where they still remain at elevated rebates levels, they are going to have a share price decline of around $13 when you look at this attribution here. Now, we think that we got comfort in not having these elevated levels going forward, because based on our conversation with dealerships and based on our conversations with industry experts, we understood that dealers now are more aware of the inventory levels coming forward and when they're placing orders. Currently, a lot of the dealers have placed their orders for the year of 2025, and they have more visibility into planning of how their orders are going to look going forward. What we saw previously is during the COVID era, why rebates were so high is dealers were optimistic on based on COVID level spending when people were more at home and order a lot more inventory. And that was why BRP had to eat a lot of those costs of discount pass-throughs. So this is where we got comfort and understanding why we were able to decrease the level of rebates BRP is going to be taking on when it helps dealers get rid of inventory.
Okay. And one more question. So I noticed that there is one close competitor to this company, right, that you keep on referring to. So what is it that BRP is doing that this close competitor could not cannibalize and try to do what they're doing?
Yeah, so there's a couple things to that. For one thing, as we mentioned before, with inventory levels, BRP has actually been able to reduce their dealer inventory much quicker than Polaris has, because during that overproduction period, Polaris kept shipping excessive amounts of inventory to their dealers, which they're now suffering from in the long term, which Polaris is just very difficult for them to catch up, as they have so much inventory to discount, which will hurt their margins. And another thing is on the innovation piece. So because Polaris is bombarded with a lot of older inventory that is hurting their income statement, they're not actually able to invest more into R&D, pushing out products that enthusiasts have expressed they want. As an expert we talked to said that enthusiast buyers always want the latest and greatest products. So with BRP having better inventory on shelves, BRP is actually able to capture share, and Polaris cannot cannibalize in this sense.
And to quickly follow on with that, our web scraping analysis also showed that BRP actually has the least amount of old inventory on dealer shelves, while Polaris has the most amount. And so we take comfort that at the dealer level, BRP's current inventory has greater market share than Polaris.
Okay, thank you. Good answers. I'll pass on to the other judge.
Thank you. Thank you, guys. Good presentation. So I have a question about the valuation as well. So in your slide, I noticed that you have, I think I have a assumption about the growth rate, and it's growth rate from 2019 to 2020. If you can pull up the slide, please.
Yes.
I think not this one, the one that you talk about, that estimation. Yeah, this one. So I think this one has a question about like, how could you, like after 2023 and your growth rate expectation just abruptly dropped from 15% to 5%. And so how that happened, and what are your logic behind that?
Yeah, so that's a great question. And I think if we go into the industry cyclicality slide, I think that explains a lot of this uptick in 22 and 23 and the subsequent decline in 2024. In 2022 and 2023, people were really interested in getting into the power sports space. And even just before that, cost of debt was a lot lower. And so it was a lot more accessible to people. If you think about the power sports space, it allows you to go outside, it allows you to be socially distanced. And so one of the experts we talked to mentioned that this was the biggest boom in power sports he'd seen in his entire 40-year career in the space. However, that caused players such as BRP and Polaris to produce too much inventory and dealers to order more inventory than they actually needed. That's where you see the decline in revenue, as can be seen on the right-hand side of this slide. And so we just view the most recent year as a normalization, and going forward, the CAGR to be 5%, which is in line more so with historical growth rates.
So if I understand correctly, you will forecasting at 5% to be the long-term growth rate.
So maybe to go a little deeper, we spoke to a consultant and he has 25 years of experience and he's run 5 dealerships in the past. He told us on average unit CAGR has been 3%, and then on average price CAGR has been around 3 or 4%. So we believe the 5% is actually lower than historical average, but we wanted to just be a little bit more conservative in the light of the recent macro headwinds.
Okay, and a follow-up question about that consumer confidence is because that you showed that evidence of the survey that presenting different views of this maybe the mass media's view about the consumer's confidence regarding purchasing the luxury motorcycle. But what is the kind of the survey is that? Do you have other evidences that support the consumer demand? Because that will be the biggest assumption, I believe, from the macroeconomics perspective. That will be a biggest assumption in your analysis because you expecting the consumer confidence to be higher, so that is a positive factor, right, into your valuation.
Yes, so one of the biggest contributors to our confidence in the assumption that power sports demand will stay consistent is the amount of dealers that reiterated the fact that they continue to see power sports demand. We spoke to over 25 dealers, and nearly all of them echoed the idea that the power sports demand throughout this period has stayed strong. One of the major sticking points that they noticed was improved personal financial health as well as a reduction in interest rates. We've seen debt to income levels improve, which will improve personal health, as well as we expect the Fed to drop rates significantly throughout the course of the year, which will support the reduction in interest rates that we believe will continue to drive power sports growth going forward. So that underlying demand is still very strong in our conversations with dealers who are closer to the source, and we believe that macro factors disproportionately benefit BRP compared to the rest of the consumer industry, which we do not believe the market is giving them credit for.
Thank you. I don't have quite one more question.
Why do you think the Fed will continue to cut rates? Do you think it is because of inflation or because of growth or recession, which might mean that people might not be able to buy these luxury products?
Yes, so as we saw today, CPI has been down in the US, and we believe that the Fed will continue to cut rates going forward as a function of growth. However, we do believe that the BRP target customer is very well insulated against potential recessions and slow growth. The overall power sports industry targets a consumer that makes about $80,000 a year in income, whereas BRP's target customer, as per their management team, targets a customer of about $140,000 of income, highlighting how much of that premium buyer segment that BRP actually targets. So we believe that this premium buyer, coupled with the lowering interest rates, will really inflect power sports demand as well as actual purchases going forward for the rest of the year and beyond.
If we take a look at what happened in the 08-09 crisis, if we go to slide 97, we can see that even though there was all the way, to the left-hand side of the chart, there was a drop in the power sports industry, it did rebound. And so we believe that this drop has occurred. And so historically, the power sports industry has always rebounded, and we have strong conviction in these premium and more resilient buyers.
Yeah, good answer. Thank you. I like the fact that you incorporated the CPI that just came out today. Good stuff.
Maybe just a quick last question. You highlighted exit from marine segment. How confident are you that the reinvestment of the proceeds will deliver equal and greater shareholder value?
It's a great question. When we spoke to BRP's management, which was sponsored by CFA, we learned that they have two priorities by selling the marine segment. The first was actually just repurchasing shares, and they've recently re-upped their NCIB, and so we feel this is an option. And the second is actually paying down debt. So the first thing we wanted to do was calculate how much money did they actually make from the marine segment, because this isn't disclosed. So if we go one slide prior, we took a precedence analysis and found that on average, the lowest value companies were around 0.9 times revenue. And we applied that multiple to their current marine business, given it's currently unprofitable. Now, if we go back to the next slide, assuming that they use the $200 million for share repurchases, they can increase their EPS by 36%. Because they're getting rid of a company that had a $1.50 drag to their EPS and using that to repurchase shares. Or they can use that to buy back debt, which we also feel is a big catalyst for the business because their current leverage ratio is above their internal target. This brings it within their internal target. And so we see the marine segment as a catalyst for the business that the market's overlooking, given the fact that it happened during all these macro concerns.
Great, good answer. No other question.
Okay, we only have about 5 seconds left, so we will wrap up the Q&A. Thank you so much, University of Waterloo. At this time, all 6 teams have now presented. The judges will now begin deliberations, and please make sure to rejoin the Zoom in about 30 minutes to hear which teams are advancing.
Thank you very much. We really appreciate your time. Thank you.
Thank you. Good luck.
Thank you,
Thank
guys.
you.
All right, we have at least one representative from each team, so we will go ahead and get started here. Welcome back and sincere congratulations to everyone. We've heard some remarkable presentations today. The level of thought and attention to detail, analysis, all of that went into this, it is very impressive. Make sure that you use this experience, put it on your CV or resume, talk about it in job interviews, be ready to learn about or talk about what you've learned, what went well and what things you may want to do differently if you were to go through this again. Every team today has already had significant success going through the competition, so it's definitely something to be proud of. The judges have scored all teams, so no more waiting. We will go ahead and tell you which teams are going to be representing the Americas region in Chicago for the global final on May 5th of this year. And the 2 teams will be Appalachian State University and the University of Waterloo. So thank you again to all the teams and judges for your hard work and dedication. Congrats again to the 2 teams that are advancing. I will be sending you a message here shortly with some more details. For everyone else on this call, you will get more information regarding the CFA program scholarships in May after the global final takes place. So well done to all, and that's a wrap. Goodbye.